So let's continue the PGBP discussion. We already started. I already gave an overview of the entire PGBP chapter, how the PGBP structure works. So PGBP chapter is completely divided into 4 parts, right? 1 talks about incomes 28 and 41. 2 30 to 38. These sections deals with expenses that are to be claimed as deduction, and 40 series they talk about conditions for giving these deductions, and last 44 series is there, which is all administrative provisions, right? Now the first segment, which is incomes, that we will discuss at last. So first we will start with deduction section. Income, PGBP charging section will not have a major impact. PGBP charging section will not play a major role in computation of income, because almost you will understand by looking at profit and loss account, by looking at the sales value, service, all that, you can easily understand that they are taxable under PGBP. So the main focus that we need to give on deductions. Okay, so what are the deductions that we have? Deductions are discussed under section 30 to 38. Now first point, you don't have to scribble everything that I'm scribbling, no need to. Focus on listening and understanding. If you really feel that is something important, write it, otherwise no need of. Even for problem solving time, you also practice along with me. Only for problem solving time you do along with me. For theory, running notes and all, not required. Every point is covered in the material, just focus on listening. Next, so the first section that we have to discuss is section 30. So what is section 30? 30 is relating to expenditure in relating to buildings, expenditure related to buildings or deduction for buildings. What is buildings exactly? There is section 32, right? There is section 32 which is dealing with depreciation. There is another section called 43 which defines what is plant and machinery, all that. What do you mean by cost? All that. There is a section which defines various things like plant and machinery, all that. Buildings includes not only the physical building that we see, it also includes roads, bridges, all that also comes as part of building. Don't imagine road means a normal road. Imagine a road in a factory. You might have seen, right? Tesla factory. Somewhere in Google or YouTube you might have gone through, yes or no? Or you see data center, Google data center, Facebook data center. These factories are giga factories, like they're very, very, very big. Like they'll be spread around 1,000 acres, 1,500 acres, 2,000 acres, 3,000 acres, big factories. Now inside the factories they will lay roads and all, right? They all come within the definition of building. Instead of calling it as immovable property, we call them as building, because land is not eligible for depreciation. Land is also part of immovable property. So instead of calling it as immovable property, the income tax law calls them as building, and anything and everything that is immovable except land, but anything that is attached to the land, that can be classified as building. Okay, so you can see the definition of buildings, all that. In the depreciation section it is given. In the depreciation section it is given. You can see here. So under section 32, in the introduction itself, buildings includes roads, bridges, culverts, wells and tube wells. Whereas plant means what? I'll come back to that later. Okay, what is meant by plant and machinery, all that, we'll come back to that later. So now we are discussing what actually section 30, deduction towards building expenses. Now again, in a building on which I am operating my business, the building in which I am operating my business, this building can be either owned by me or it would have been leased by me. Yes or no? I am staying in that building either in the capacity of owner or in the capacity of tenant. If at all I am staying as a owner, I will not have rental expenditure. What I will not have is rental expenditure, because I am the owner. What I will have, if at all I am staying as a tenant, what expenses we will have in relation to building? Tell me. As a tenant, first we will discuss. First one is obviously rent. This is directly attributable expenditure relating to building. So you can claim deduction for rent incurred. Now, in the section of 30 to 38, at so many places, you will see the word paid or you will see the word payable. Sometimes in PGBP you will see the word paid, and also at certain places you will see the word payable, received or receivable. How should we interpret it as? What do you mean by paid? Generally, whenever we think of the word paid, we naturally assume that it is cash basis. Only when you actually pay, you get deduction. That's what we naturally assume it as. But in PGBP, that logic will not apply. In PGBP, that logic will not apply. There is something called method of accounting. There is something called method of accounting where there is a section called 145, which deals with method of accounting for computation of income. What is the method of accounting for computation of income under PGBP and under other sources? So method of computation of income under section 28 charging section, that is nothing but PGBP, and under section 56 charging section, which is nothing but other sources related charging section. How to compute income under these two heads of income? What method of accounting we should follow? There is a section 145. It says follow that method of accounting which the SSC regularly follows. The 145 section says follow whatever the method of accounting SSC is following. Follow the method of accounting which the SSC regularly follows. What do you mean by regularly follows? Look at a company. Suppose take an example of a domestic company, Indian domestic company registered under Companies Act. What method of accounting they follow? Accrual or cash? Which one? Mandatory accrual. Even a section 8 company, a normal company, manufacturing company, trading company, or even a section 8 company, non-profit entity under Companies Act, they must follow accrual system. Am I right? They cannot. They were not even given. There is no even special permission concept there. A company by default has to follow accrual. So which means the company regularly follows what method of accounting? Accrual. Now under income tax law, while computing PGBP income, which method of accounting I should adopt? Accrual. So while computing PGBP income, what method of accounting we should adopt? Whatever method regularly they follow. Sir, company regularly maintain books of accounts on accrual basis. I will also follow accrual. Under PGBP also we have to follow accrual. Now when I say accrual, what do you mean by that? Income is taxable. Income is taxable, not on receipt basis, not even on receivable basis. Income is taxable when the right to receive is established. When the right to receive is established, income is taxable on that basis. You can typically apply Ind AS logic, revenue recognition logic, no problem. You can exactly apply Ind AS 115 logic, whatever revenue recognition logic or accounting standard 9 revenue recognition concept is there, right? They were predominantly developed based on accrual principle. So the same principle you can apply in PGBP. For which entities? If the entity routine method of accounting is accrual. So income is recognized, income is taxable the moment you have a right to receive it. Same is the case with expenditure. Even for expenditure, for expenses also, you can claim deduction if you incur. That's enough. You incurred, you spent, that's enough. Now here, in certain sections they use the word paid, in certain sections they use the word payable. They both are equal. Whether the word paid means, is it actually paid? No. The word payable means it should be accrued. I mean, there is no such link at all. They use these two words interchangeably. These words are used interchangeably entire across income tax law. I mean, especially PGBP, entire all the deductions, they use the word paid and payable interchangeably. It does, paid means, paid does not mean actually paid. Payable, of course, accrual concept now automatically comes into picture. So just because somewhere you see the word in PGBP like paid, received, don't think that they were actually received or they were actually paid. It depends on a method of accounting. Yes or no? So paid includes payable. That's what the meaning. Paid includes payable. So the primary point is, on what basis I can claim a deduction? Sir, for example, rent expenditure I incurred. 12 months period is there. April to March. Yes or no? Previous year. Right now, for our exams, what previous year is applicable? 25 to 26. Yes or no? April 2025 to March 2026. April to February, we always pay rent on next month 5th date. Whereas March month rent we pay it on April 5th. Still, you can claim all 12 months rental expenditure deduction under section 30 if at all you are following accrual. Clear? That's it. So paid includes payable. Now there are certain expenses. Okay, you might have heard 43B. There is a section called 43B. Certain expenses were allowed as deduction only if they were actually paid. Certain expenses which are allowed as deduction only when they were actually paid. You might have seen interest on loan from banks and financial institutions. You might have seen bonus or commission, leave encashment, payment to railways, payment to MSMEs, taxes. Yes or no? There are so many points like this. You might have, provident fund, employee welfare contributions. There are 7 payments. Typically, we can classify them as what? 7 types of expenditure. These 7 types of expenditure were allowed only when they were actually paid. It is not allowed based on method of accounting. They were allowed only based on actual payment basis, and that's what 43B says. Only for those 7 actual payment obligation is required, which means rest all other deductions you can claim depending upon method of accounting you follow. Am I right? Can we conclude that? Yes or no? Like some of you might still have a doubt, sir, paid includes payable, you said, right? Yes or no? So all that is fine. Still I'm not getting one dot. If you think, apply 43B logic. Under 43B, 7 expenses were there. 7 deductions they're talking about. These 7 deductions, you can claim deduction only when they were actually paid. When they specifically say the following 7 you will get deduction only when you actually pay them, remaining items you can still claim deduction when you incur. Am I right? Can I conclude that? Yes or no? That's why 43B specifically is applicable for those SSCs who are following accrual method of accounting. 43B section applies to an SSC who follows accrual method of accounting. See, if an SSC is following cash basis, if the SSC is following cash basis, forget about those 7. Every expenditure, every deduction will be allowed only when it is actually paid on or before 31st March. Am I right? What is cash method of accounting? I collected income from debtor. Only when I collect, I will show it as a sale. Not when I sell the goods. I may sell goods to the customer on credit, but I will not recognize it as sale. When I sell the goods, I will not recognize it as sale. When I collect the money only, I will recognize it as, a sale. That's why you see in cash basis of accounting, there is no concept of bad debt. In cash basis of accounting, there is no concept of bad debt, because first of all, you didn't recognize the debt so as to have bad debt in the books of accounts. Able to understand? So in cash, only when you collect, you show it as income. In for expenses, only when you actually pay, you will get deduction. That is cash basis of accounting. Now the question is, for us in exam, which method of accounting is mostly tested? Mostly accrual. Mostly what is tested is accrual, because the 14 marks question I told, right, first question, usually they ask company taxation. Usually what they ask? Company taxation. Like they'll give a company name and the company is doing so and so business. So company taxation is what they will test. 99% of the cases you get company taxation, that too accrual testing. Are you clear? Now cash basis of accounting, if at all they ask, how they will ask? They will ask it for doctors and CAs. If at all they are asking individual taxation question, individual SSC related taxation question, if at all they are asking in exam, that too CAs, professionals, not businessmen, professionals, when they are asking, then usually they ask cash basis of accounting. You might have seen in CA inter PGBP problems, like a CA engaged, a CA in practice, a doctor, yes or no. There you see cash basis is what? They'll give you receipts and payments account there. They'll not give P&L account. Yes or no? Whereas rest all other cases, accrual basis problem, they give you generally P&L account. The moment you see P&L account in a total income problem, you can blindly assume that it is accrual. But irrespective of that, always look for what method they're following. If they did not mention specifically any method in the question, if they don't mention about method of accounting, assume it is accrual. Take an assumption that it is accrual. Are you clear? Fine, I will not give this explanation again. Okay, so I spoke about entire PGBP method of accounting, what is applicable. So now again go back to this section 30, deduction for buildings. So what deduction? First one, as a tenant what you can claim? Rent. As a owner you will not have a rental expenditure, am I right? For owner, rental expenditure is not applicable. Apart from that, rent, what are the other expenses that we incur? Electricity, that's not related to building. We don't call it as building expenditure. Electricity is a separate expenditure altogether. Electricity, power and fuel, you can claim deduction under section 37. You can claim deduction under what section? 37. You will not claim under 30. Municipal taxes. Next, another deduction that we claim is what? Municipal taxes, or we can also call it as property taxes. Mostly for commercial properties, certain commercial properties, tenants will pay property tax, not the owner. Again, it depends upon their agreement. It's a contractual term. Okay, whether owner will bear the municipal tax or tenant will bear the municipal tax, property tax, that's a contractual term. So municipal taxes is second expenditure related to and exclusively incurred for building. So municipal tax is something which is common for owners as well as tenants. Either of them will pay, any one of them will pay, or 50-50 sharing basis, whatever it is. Now for municipal taxes there is a condition, 43B. For municipal taxes there is a condition called 43B. What is 43B? If you see the point, taxes subject to 43B, we would have wrote subject to 43B. What is subject to 43B means what? Rent, you are following accrual method of accounting, no problem. You accrued, you incurred, claim deduction, no problem. But municipal taxes, if you incur, suppose there is a due every year, every half yearly once you have to pay municipal tax. 1 half year over, you were issued with a challan, you were issued with a demand notice, you accrued the liability, you accrued the expenditure, but you didn't pay it, you will not get deduction. So wherever if you see the word subject to 43B is there, they are all allowed as deduction, not when you incur but when you actually pay. Are you clear? So municipal taxes is another expenditure relating to buildings. The third expenditure relating to buildings is repairs and maintenance. The third one is what? Repairs and maintenance. Whether you are incurring as a owner or whether you are incurring as a tenant, that doesn't matter. Obviously every day building maintenance, all that has to happen. Some minor repairs if at all arises, we need to do, yes or no. So the owner or the tenant, as the case may be, whoever is bearing it, they can claim deduction. Remember, when I say owner can claim deduction means which owner? I'm not talking about tenant's owner. The building you are using for your business, either as a tenant or as a owner. Suppose I'm running my practice, CA practice, in my own building, in my own residential house. So building is owned by me. As a owner, I can claim deduction for municipal taxes. I can claim deduction for repairs and maintenance. Suppose I took a building on rent and then I'm paying rent also, then you will also get deduction for rent. That's it. As simple as such. Now for example, sir, I'm a tenant, sir. I'm paying rent to the owner, no? For owner, where it is taxable? House property head of income. For owner, where it is taxable? The rental income which I pay? House property head of income. Understand? So in house property, you might have understood one thing. You see the charging section of house property. Annual value of any property consisting of buildings or land attached thereto, for which the SSC is the owner, is chargeable to tax under income from house property. If there is a building and if it has an annual value, that's it. House property head of income is applicable. And if you are owner, whether that building is rented for commercial purpose or residential purpose, that doesn't matter. So from building, whatever rental income is that is taxable for the owner under the head house property. Here I'm discussing owner, right? I'm discussing about that owner. No. I'm discussing about a owner in whose premises he is running a business. Yes or no? Then he will not have rental expenditure because it's his own building. Yes or no? So municipal taxes and repairs and maintenance. Now sometimes these repairs and maintenance might include capital expenditure, capital repairs. Capital repairs are those repairs which will enhance the life of an asset. When do I say a repair expenditure as capital repair? When the repair is such that the benefit is, the economic benefit is not just for the current year, it is for future years as well. Probable future benefits that are there, then we call that as capital repair. If at all the repair and maintenance expenditure, see, maintenance is always revenue. Repair, the question arises, is it capital repair or a revenue based repair? If it is a capital repair, we should not claim deduction for that under section 30. If the repair is of capital nature, that's not eligible for deduction under section 30, because section 30 only gives deduction for revenue expenses. It will not give deduction for what? Capital expenditure. But now I spent a capital expenditure. What should I do? Capitalize. What you should do? Capitalize. And what is the accounting treatment for capitalized repairs? Depreciation. Same is the case with income tax also. Clear? So if at all capital expenditure is incurred, capital repairs are incurred, what we gave? Add it to the block. What is it? Add it to the block. You just see this. Capital nature of expenses, you see. Okay. Repairs of capital nature, whether you are incurring as a owner or whether you are incurring them as a tenant, they are not deductible. Rather, they are added to block of asset as addition, and depreciation can be claimed by SSC. You see this? Able to find? Everyone? Yes. So capital repairs is added to block of asset and you can claim depreciation. At what rate? Since it's building related a capital expenditure, what is the rate of depreciation on building under income tax law? 10%. What is the rate of depreciation? 10%. That's it. That's it. So with this, section 30 is almost done. Section 30 is almost done. So building occupied as a tenant. Rent paid is disallowed. Paid means what? Paid includes payable. Remember that it depends upon method of accounting. That also we have given at the beginning itself. 145 section is also given at the beginning itself. Well before the concept of ICDS, it will be there. You can see here. 145 subsection 1. In fact, the starting concept in the chapter. Method of accounting. What is given here? Income under profits and gains from business or profession and income from other sources. They must be computed using either cash or mercantile of the accounting, mercantile system of accounting regularly employed by SSC. You may, if the SSC follows regularly cash, then follow cash method. If SSC regularly follows mercantile, then follow mercantile method. Yes or no? In the entire PGBP chapter, paid includes payable and vice versa, given at the beginning itself, except for 43B. Clear? Every line, every heading given in this book, every word is selectively chosen and then added. So when you're reading, even if it is a heading, how you read the concept and keyword, in the same way you have to read, with the same level of intensity you have to read. Clear? Every point, I'm telling you, when you're revising later, every point, every dot will be connected in this book. You won't be left anywhere vague. So that vagueness won't be there at all. That's it. So now again, go back to 30. Then again, the second expenditure is what? Cost of actual repairs borne by tenant. Property taxes subject to 43B or any building insurance and any other expenditure related to buildings can be claimed as deduction. Suppose if at all you are running business in your own premises, you are running, you cannot claim deduction for notional rent. There is no, income tax law does not recognize the concept of opportunity cost. Remember, in PGBP one thumb rule, only a real expenditure you will get deduction. You will not get a deduction for notional expenditure. Provisions are notional expenditure. What are provisions are? Provisions are basically notional expenditure. You will not get deduction for provisions generally. You will get deduction only when the expenditure is real. That's why you might have seen in CA Inter provision for gratuity. No deduction. Yes or no? Because they are not real expenditure. They are all obligatory which are at a future date, which we may incur, we may not incur also. Clear? Then sometimes what happens is a partnership firm will be there. They will rent the building from a partner. They will rent the building from a partner. Partner owns the building, and the firm, you know, right? Firm and partners are different. Yes or no? And the firm can take the building on rent from partner. The building on rent can be taken from partner. So in such a case, whatever the reasonable rent expenditure, whatever reasonable rent expenditure is there, the firm can claim it as deduction. So when the firm which is running the business, when they're computing income under PGBP, if at all there is a rental expenditure where the rent amount is paid to actually partner, related party, nothing but, okay, 40A subsection 2, there is a section called 40A subsection 2, that section comes into operation. The moment when 40A section comes into operation, 40A subsection 2, we look for reasonability of the expenditure. Is the expenditure incurred reasonable or not? Is it beyond market value or at or below market value? We will see. If at all we feel that it is extremely high, beyond market value, we will not consider the excess expenditure. We only take reasonable expenditure. That's it. So whatever rental expenditure that is excessive, we will not allow it. Then again, expenses of repair. Obviously, the owner, if at all he is spending on repairs, he can claim deduction. Property tax is subject to 43B. This point is exactly same, just like tenant concept. Clear? Sometimes what happens is there will be a premises which I own, or maybe I would have taken on rent. But that premises I'm using partly for business and partly for other purposes. See, we didn't mention residential. We just mentioned other purposes. It could be residential purpose or it could be some other source. It could be related to other sources. Yes or no? So I am using a building partly for business and partly for some other purpose. Then what? Proportionate expenditure pertaining to business. Only that much can be claimed as deduction. That time repair expenditure, property taxes expenditure, rent expenditure, everything will be splitted. Everything will be apportioned only towards business, and only that portion can be claimed as deduction. So whatever the share of expenses related to business purpose is allowed as deduction. Further, if house property is partly used for business purpose, the actual repairs proportionate for business can be claimed as deduction. Suppose I have a house property. 2 floors I have. First floor I'm using it for my residential purpose. Ground floor I'm using it for my business purpose. For both the floors put together, commonly I incurred some repair expenditure. Repair cost is 1 lakh. Ground floor 50%, first floor 50%. Ground floor 50%, 50,000 rupees, I can claim it as deduction under section 30. Under PGBP, I will show it as deduction. First floor related 50,000 is there, I will ignore it. Because in house property, you don't get repairs deduction whatever you incur. You get a flat 30% deduction. Yes or no? You might have seen in house property, you will get flat 30% deduction of NAV. Clear? Remember, under house property, the deduction is flat 30%. Whereas under PGBP, it is actual expenditure. That's it. In one of the exam, they have asked this as an adjustment in PGBP problem. So sometimes they'll give you, for example, in May 25 attempt or, September 25 attempt, I'm not sure. In one of the attempt, they ask a tedious question where you have to compute income under the head salary. They asked a TDS section. We have 192. There is a TDS on salary. There is a section called 192. How much TDS we should deduct under 192? Average rate of tax, like that, something they say. For that, in the exam, 3 marks or 4 marks question only it was TDS. Again, see, there is one more chapter which is very big chapter, which is a big chapter. Not too big like PGBP, but high weightage chapter is TDS TCS chapter, which is 13th chapter in our book. That will have a weightage of minimum 8, most common is 12. Every attempt it will be 12, sometimes 14 marks also. Easily scoreable. Okay, so 192 they asked. There they gave salary details of the employee. You need to compute income from salary and then you need to compute tax liability. So that's why I told you, if you don't want to lose even 1 mark, even 1% probability also, you don't want to keep a risk. Watch CA Inter Audit Marathon, CA Inter Tax Marathon, CA Inter Income Tax Marathon is there, right? For salaries and house property, just watch once. I already told in the very introduction. Yes. That's it. With this section 30 is over. Clear all of you? If 30 is, if at all you understand 30, 31 is dead easy. What is 31? Expenditure in relation to machinery, plant and furniture. Again now, plant and machinery means what? In income tax, plant and machinery is a residuary category. I buy any capital item. I buy any capital item, any machine, any product that I buy. We can classify them into only two parts. Any product I buy in my business, any product, anything that is a tangible thing, whatever, something which is a tangible thing or a product, you may either classify this as stock in trade, or you may either classify that as a capital asset. Either it is a stock in trade or it is a capital asset. Capital asset means what? Basically, generally depreciable assets. Capital assets are basically what? Depreciable assets. Now these depreciable assets under income tax law, that too specifically under PGBP, there are four categories. There are four categories. One is building, furniture and fixture, and I can say first I will write intangible better. So intangibles, buildings and furniture fixture, and plant and machinery. What do you mean by plant and machinery? Any asset that you bought for business, any asset that you bought for business which does not fall under the above three. It's not a building, it's not a furniture, it's not intangible. You can call it as what? Plant and machinery. I bought a laptop, that's a plant and machinery. Phone, plant and machinery. Camera, plant and machinery. Speakers, plant and machinery. Electrical fittings, maybe electrical fittings comes under furniture and fittings. Okay, lights, fans and all, they come under what? Furniture and fittings. So I bought an aeroplane, for example, big companies, blue chip companies, they'll have aeroplanes. Okay, just to charter flights will be there, private jets will be there, so they'll have some flights. Okay, they all come under what? Plant and machinery. So plant and machinery is a residuary category of depreciable asset. Every asset that is not an intangible, that is not a building, that is not a furniture, directly comes under what category? Plant and machinery. Like this, we have totally how many categories of depreciable assets? 4 categories of depreciable assets. Suppose you bought some raw material, that's none of this. That directly comes under what? Stock in trade. You bought inventory, some raw material inventory you bought. You are using it for own business. You are using it for your own business. Then again that comes as part of depreciable asset. That's what we call it as conversion of stock in trade into capital asset. Not conversion of capital asset into stock in trade. Conversion of stock in trade into capital asset. Fine, I'll come to that point at 32 discussion. When I'm discussing depreciation, I'll come to that. So next section is what? Section 31, which is dealing with expenditure in relation to plant and machinery. Tell me what expenditure will be there? Repairs and maintenance, insurance expenditure, that's it. If it's a capital expenditure, what is the treatment? Can I claim deduction directly? No, I can't claim capital expenditure as deduction directly. Now again here, one thumb rule. One thumb rule I'll tell you. In PGBP, all revenue expenses, you may claim deduction under 30, 31, 32, 33, 34, whatever. Any revenue expenditure that you incur, by default, you can claim deduction. You can easily claim deduction unless it is prohibited. Unless it is prohibited by some other section. For example, 43B you say, 43B section, some 7 expenses are there. They are all revenue only. But 43B says you can claim deduction only when it is actually paid. Okay, so there are some restrictions. By default, if it is a revenue expenditure, you can claim deduction, no problem at all. You can claim deduction. Now, what is the thumb rule for capital expenditure? By default, you cannot claim deduction. Any capital expenditure that you incur, you cannot claim deduction by default. Rather, what you can claim? Depreciation, unless otherwise specified. If at all specifically there is a section that says you get 100% deduction for capital expenditure, then only you claim it. That time depreciation concept will not apply. So for capital expenditure, what is the default rule? Capital expenditure means depreciation only we can claim. We cannot claim straight away 100% deduction. That's the default rule. But what is an exception? If specifically if a section says you can claim 100% deduction for the capital expenditure, then you can claim. Example, capital expenditure incurred on scientific research. You might have seen 35 capital expenditure incurred on scientific research. You remember 35 AD? Specified businesses. What is 35 AD section dealing with? 3580 section deals with 100% deduction for capital expenditure. 3580 does not deal with revenue expenditure. 3580 is exclusively dealing with what? Capital expenditure of specified businesses. 14 businesses were there. We'll discuss that. This is the thumb rule. So whether I call it as building, whether I call it as plant and machinery, it doesn't matter. As long as it's a revenue expenditure, you can claim deduction by default unless otherwise prohibited. Clear? So look at this. So what is the first expenditure? Repairs and maintenance. Yes or no? Can I claim repairs and maintenance expenditure of plant, machinery, furniture? Absolutely. As long as assets are used for business of the SSC, you can claim. Correct? If at all they are used partly for business and partly for other purpose, then only business related portion is allowed as deduction. Most common adjustment is car. What is car? It's a plant and machinery. Under income tax law, car comes under what? Plant and machinery. Vehicles, all vehicles, everything comes under plant and machinery. I am practicing CA, for example, I am using car, 50% for my business, 50% for my profession, personal purpose. Then only 50% I can claim it as deduction. This is also a common rule across all the sections. Now, usage includes passive usage as well. What is meant by passive usage? For example, I bought a generator. Best example. During the year, there is no power cut at all. During the year, there is no power cut at all. But the generator was already installed. The moment power shutdowns, generator will activate immediately. Automatically it activates. But unfortunately or fortunately, there is no power cut at all in the entire 12 months. Now, can the department deny deduction for generator related expenses? They cannot. I have to still maintain the generator. I have to repair it as and when need arises. Yes or no? So passive usage is sufficient. This is something common in Companies Act also. Even under accounting standard also, passive usage is sufficient. Yes or no? Next. Repairs includes renewals, renovations, but not complete replacement or reconstruction. Okay, complete replacement. See, there is one point. If at all you are replacing some worn out parts, okay, some parts were completely worn out, you are replacing it. Just you are replacing a worn out part. Best example, for example, car is there. Brake pads will be there. So brake pads will be worn out. So you are replacing the brake pads. That's a capital expenditure or revenue expenditure? Revenue expenditure. It does not improve the life of the asset. It will not improve the life of the asset. I will show you an exam question on that. Exactly that point is tested. ICDS 5, I guess. Yeah. You can see here. In May 23 exams, they tested one adjustment. What adjustment they tested? Replacement of worn out parts is treated as what? Revenue expenditure. What is it treated as? Revenue expenditure. You are purchasing spares, for example. Spares is not revenue expenditure. Spares is a capital expenditure because of spares, what happens? Life of the asset will perform better. Yes or no? Spares will be added to machinery cost. And depreciation is applicable. November 2019 exam. These are just one adjustments. But if you just read this here, tomorrow when you see suddenly the adjustment, you will not be surprised. See, when you will be most confident in exam, when the surprise element is less. The bigger the surprise element in the question, the more stress it creates. That's it. So replacement of worn out part is a revenue expenditure. Now here you can see 31 again. Not complete replacement, they said. There what we told? Worn out part replacement. So both are different. Understood? If at all a particular part of the machine is worn out and we are replacing it, that's not a complete replacement. If you are completely replacing the machine, that's a capital expenditure. Am I right? Yes or no? That's it. And remember, only current repairs are deductible. Current repairs are nothing but revenue repairs are deductible. Repairs which are capital nature, they are not deductible but are added to block of asset. See, whenever I say in income tax added to block, it means capitalize it. In accounting, you call it as capitalize. In income tax, we call it as added to block. Because in income tax, how do we capitalize an expenditure? By adding it in the block of asset. Sir, what is block of asset? I didn't remember at all if you say. Wait for depreciation concept. You are not supposed to say this statement after clearing CA Inter. Okay, but if at all by mistake, if at all you still think where is block, what is block, it's okay, no problem, I can understand. So in the section 32 depreciation discussion, I will tell you. Next, for example, arrears of repair. There is another concept called arrears of repair. What is arrears of repair? Current repairs. Remember, this section allows deduction only for current repairs. Indirectly it says current year repairs. What is arrears of repair? Some 2 years back, I gave my car for service, for example. Okay, so initially estimation was 1 lakh rupee the repair cost. After complete work is done, 2 lakh is what billed me. He billed me 2 lakhs. So 20% variation, I agree, but he outrightly billed me 2 lakhs. So I said, no, you told me 1 lakh, 20% margin variation is there. In the quotation also you mentioned 20% variation. I will pay only 1.2 lakh. Now he went to a court saying some exceptional repair is there, all that, some miscommunication and all happened, all that. 80,000 rupees is, he filed a case on me to recover from me. And finally the court case was settled, and this year the court ordered me to pay 50,000 at least pay 50,000. Now this is a repair expenditure which I am paying in arrears. Are you clear? So arrears of repairs, that is not covered under section 31, but nothing to worry. We have 37. There is a section called 37. This is incurred for business purpose. If you are incurring it for business purpose, that's enough. So you can directly claim under 37. Clear? Actually, in PGBP, by adding 30, 31 and all, they're making it complicated unnecessarily. You don't have to tell all this. You incurred any expenditure relating to business, claim deduction. If it is capital expenditure, don't claim deduction, add it to the block. Any expenditure relating to business, simple. Building related, some rent I am paying. Is that building used for business purpose? Yes, then claim deduction. Proportionately only used, then proportionate only claim. Over. The concept is over. They don't have to add all the sections and then write all this. Then another expenditure I incur is obviously just like buildings, even for machineries and all also we take insurance. Whatever insurance premium that we are paying, that is eligible for deduction. So deduction allowed for insurance premium paid, where the insurance is against what? Damage, destruction, theft, whatever. Now in some MSMEs, no, especially in semi-urban areas and rural areas, no, insurance they will not directly buy from insurance company. There will be some association, trade association will be there. The trade association will provide insurance facility to all the members. For example, this is very popular in milk cooperative societies. This is very much popular in milk cooperative societies, and certain cottage industries it is very common. They don't want to go and buy insurance from outside well-established insurance company. They want to buy insurance from the association. Whatever amount you paid for association for insuring the assets, you can claim deduction. See, if there is a real expenditure involved, you can claim deduction. Simple. Genuinity, if it is there, that's enough. Contribution to a trade association for insurance. Why are you contributing to the trade association? If at all tomorrow you suffer a loss because of damage or destruction, that loss will be indemnified by such trade association. That is also deductible, even if a part of it is returnable to the insured in certain circumstances. Okay, that's not a big deal. Let's leave it. Generally, when I say insurance, what people generally think insurance means you should buy insurance only from recognized IRDA insurance company. Sometimes in exam what they'll tell they'll give you adjustment like this: insurance contribution, payment of insurance to association, trade association for insuring the asset, where the loss will be indemnified by them. Within bracket they'll tell this trade association is not a recognized IRDA institution. The moment when we say not recognized, we assume what? No deduction available, because that's what they're trying to trigger you. So you still get deduction because that's a genuine expenditure. Are you clear? So this point you need to remember. If at all they specifically test this, within bracket they will mention this trade association is not recognized by IRDA. So to a non-recognized IRDA, to a non-recognized association, you are paying insurance. So will you get deduction or not? Here the question is to whom you are paying. That's not the question. Have you incurred or not is the question. Are you clear? So genuinity of the expenditure is important. That's it. Sometimes to confuse you, they'll say repairs expenditure paid to a company which does not have any license or established nothing. They'll tell you something like this. No, don't worry about it. It's a genuine expenditure. You can still claim deduction. Clear? That's it. So with this 30 and 31 is completely done, where I also discussed about a slight idea of method of accounting concept. Method of accounting concept I already completed. One or two adjustments related to ICDS 5. There is a standard called ICDS 5. Tangible assets related to clarifications also I touched. Clear? That's it. So with this 30, 31 is done. We need to start 32. Just 5 minutes gap, we'll immediately start. Yes. Let's begin the concept of depreciation, how to calculate depreciation. This is one section where at CA Inter you think you understood, but actually not. Because if a slightest complex problem arises in section 32 depreciation, especially when sale happened from the block, most of the students do mistakes. That's because there is something called allocation. You need to learn how to allocate the block value. Fine, don't worry. I'll discuss from scratch very clearly all the points. So, section 32, depreciation. First point, you won't claim depreciation under Income Tax Act asset-wise. You will claim depreciation only block-wise. But before we discuss about depreciation computation logics, we need to understand one point. The enterprises, the businesses are broadly divided into two categories for the purpose of depreciation. One is power undertakings. You can call them as power sector simply. Entities, SSEs who are engaged in power generation, power distribution, power generation and distribution, or you can also call them as power transmission companies. Okay, so power generation, they're manufacturing power, or they are involved in distribution chain, or they're doing both. So these entities are simply called as what? Power sector. Then all other entities, you can simply call them as others. 99% of the cases in exam we get relating to others only. We don't get any question relating to power sector generally. We 99% get only relating to others. Now for power sector, you will claim depreciation asset-wise. You will claim depreciation asset-wise. You will not claim block-wise. What is block? I'll come back to it. I'll come back to when I'm discussing about others. So for power sector, depreciation is claimed on asset-wise. Rates of depreciation were also different. The rate at which depreciation is to be calculated, the rates are different. For that, a separate schedule is given, separate table is given. And the power sector might follow either ASLM basis or WDV basis, whichever they choose in the first year of their business. In the first year of their business, whatever the way they choose, so that method they can follow. Suppose in the first year when they started the business, they choose SLM basis, then lifetime under income tax law, that power sector entity is assessable for depreciation only on SLM basis. They can't change method. There is no concept of change of method of depreciation in income tax law. It is there only in books of accounts. Under income tax PGBP, there is no concept of change in method. So when you are auditing a power sector, especially if at all you are doing a tax audit of power sector, especially that if it is a first year, you should specifically ask the client, sir, which method you want to follow, SLM asset wise or WDV asset wise, which one you want to follow. If you have this option is there. So SLM, by the way, SLM is asset wise, WDV is block wise. SLM, straight line method of accounting, asset wise. Or sir, I want to follow routinely like others, sir. How others are following, in the same way power sector also want to follow. Yeah, no problem at all. So you can happily follow WDV method of depreciation, that too block wise depreciation, not asset wise depreciation. So which means power sector has two options: asset wise straight line method or block wise WDV method. This option they need to exercise in first year in which they got incorporated. For the first year for which they're filing IT return, that time itself they need to choose. And once the option is chosen, forever it is the same. And do you know there is something called additional depreciation? You might have seen in CA into additional depreciation, power sector entities and manufacturing entities. Yes or no? Power undertakings and manufacturing undertakings, they are eligible for additional depreciation. Yes or no? Now they said power undertakings is eligible. No? When the power undertaking is following WDV block method. When the power sector is when the power sector or power undertaking, if that undertaking is following WDV method, that to blockwise method, then only they can claim additional depreciation. Suppose if the power sector is following SLM asset wise, additional depreciation is not eligible for them. They cannot claim what? Additional depreciation. See, remember, depreciation is two types: normal depreciation, additional depreciation. Additional depreciation only two entities can claim: manufacturing entity and power sector. These two entities can claim obviously only when they follow WDV block method. If at all they are following SLM method asset wise, they cannot claim additional depreciation. This is one important point that you should remember, MCQ. Okay, so if a power sector is following SLM, asset wise basis, additional depreciation they cannot claim. But if at all they are following WDV block method, absolutely they can claim additional depreciation. Clear? Now, how to compute depreciation for others? How to compute depreciation for others? By default, block of asset method. What is it? Block of asset approach or block of asset method. You may call any of it. Okay, so block of asset method is what applicable. Now, what do you mean by block of asset? Before I even discuss about block, in income tax, when do we calculate depreciation? On which date we should calculate depreciation? This is even more important question. On which date you should calculate depreciation? End of relevant previous year. What is it? End of relevant previous year. For example, for our November 26 exam, the previous year applicable is 25-26. That is only relevant previous year. End means what? Which date? Exactly, 31st March 2026. On this date we should calculate depreciation. We should calculate depreciation on which date? I'm talking about computation on which date. Okay, so we should compute depreciation only on this particular date. We should not compute depreciation under section 32 on any other date. You should only compute on which date? 31st March. Now there are two conditions. There are two conditions attached to this date. One, condition number one, there should be an asset. If I have to claim a depreciation, there should be an asset. But tell me, am I claiming depreciation asset wise or block wise? Generally, what method I follow here? Block of asset method. So there should be at least one asset in the block. There should be at least one asset in the block. This is condition number one. There should be at least one asset in the block. Indirectly, what are they saying? You want to claim depreciation on a block? Block should be there. First of all, what should be there? Block should be there. Only when the block is there as on 31st March. See, first tell me, first on which date we should calculate depreciation? 31st March. If I have to calculate depreciation, asset must be there, right? Here instead of asset, what do we call? Block. So block must be there first of all. As on 31st March also, block should be there. Yeah, block is there. Fine, block is there, condition one satisfied. Condition number two, you want to depreciate, right? You have to depreciate some value, right? What we depreciate? The value of the asset is what depreciates. There should be value. What is it? There should be value. Here in block, we don't simply call it as value, we call it as written down value. What do we call it as? Written down value. There must be written down value of the block. Block should be there, written down value should be there. Both are there, then calculate depreciation. Simple. Any one missing? Sir, block is there, sir. Value is not there. What is not there? Written down value is not there. So if value is not there, how will you depreciate? If value is not there, how will you depreciate? Tell me. You can't calculate depreciation without value. Sir, value is there, sir. Block is not there. then also you can't calculate depreciation. Am I right or not? So two conditions you need to satisfy for a particular block. For a particular block you need to satisfy two conditions. One, in that block at least one asset must be there. In that block there must be some written down value left, so that I can claim depreciation. Any one condition failed or both failed, any one condition failed, then section 50 comes into picture. Section 50 is a short-term capital gain or short-term capital loss on depreciable assets. Section 50 comes into picture. 50 deals with what? Short-term capital gain, short-term capital loss related section. Are you clear? Until now clear? Now, sir, condition number one. There must be at least one asset in the block, right? First of all, what is a block? What is a block? There are two conditions. There are two criteria here. Okay? Simple. Suppose you see this classroom. Okay? We have chairs. Yes or no? Some interior work we did. Ceiling and all is there. Yes or no? Lightings is there. Fittings is there. Laptop is there. iPad. Camera. Speakers. Television. There are so many equipments that are there, right? You may buy any number of equipments. That doesn't matter. I need to classify these all equipments under income tax into various blocks. I need to divide them into various blocks. Assuming this building also owned by me, for example, every asset you purchase, okay, you need to classify them into multiple blocks. How should I classify them into multiple blocks? This is the question. How should I classify them into multiple blocks? Simple. So what do you mean by block? I should understand. If I have to classify into multiple blocks, I should understand what do you mean by block. What do you mean by a block? One or more assets. One or more assets falling in same category. Falling in same category and carrying same rate of depreciation. One or more assets falling in same category and falling in same rate. If multiple assets, they all come under plant and machinery, and all of them also have same rate of depreciation, then you can group them into a single block. Example, look at the rates of depreciation at first. So in our next upcoming pages, you will find rate sheet. Depreciation's rate schedule will be there. You can see this. After computation format, it is there immediately right after that. Yes. Depreciation rates. Correct? So what is there here in the depreciation rates? Rates of depreciation. You can see here. For intangibles. For intangibles, the rate of depreciation is how much? 25%. Patents, copyrights, trademark, license, franchise, any other commercial right. Okay, any other commercial right. They are all eligible for what rate of depreciation? 25%. In one of the exam, I think I would have given somewhere the intangibles, non-compete fee. I've given one place, I think non-compete fee point. Okay, fine. One-time franchisee fee is there. That's okay. Okay, fine. Non-compete fee is there. What is non-compete fee? Suppose there is a partnership form. One problem is there in one of the exam. Okay, there is a partnership form. What the partnership form did is one of the partner left. One of the partner retired. To that partner, the firm paid non-compete fee, so that he will not start one more business, because he knows all the secrets. So he will not start the same business competing with us. So to stop him, we paid a non-compete fee. Some lump sum amount, a periodical amount, or something we are paying. Is this non-compete fee an intangible asset? You got my question? It's a right, no? It's some sort of commercial right, no? Because he is not doing business, we are paying money. Because of that, our economic benefits are flowing to us. Am I right or not? So can a non-compete fee paid, can it be considered as an intangible? Technically speaking, it does not satisfy intangible asset definition. It does not satisfy intangible asset definition. But in that particular question, they give two answers, two alternative answers. One, payment of non-compete fee. Okay, that's a revenue expenditure. and claim it as deduction under PGBP under section 37. That is one option. Second option, second alternative what they've chosen, alternatively you can choose this as intangible and you can claim depreciation. So two alternatives they have given in that particular exam. So remember, when there are two alternatives like this, tomorrow if the same question comes for you, you also write the second alternative. Able to understand? Also write second alternative. In that particular question, it was tested like that. Technically, non-compete fee does not satisfy the definition of asset. It won't satisfy. Yes or no? It doesn't create any asset. So technically that's wrong. But that's why they gave two alternatives. One alternative they took is treating it as expenditure. Another alternative they have considered is capitalizing as an intangible and then they're calculating depreciation. So you can just take a note of that point. Non-compete fee. Okay. Option number one. Option number one. Okay. Claim it as deduction under section 37. Option number two. When we are solving this problem, when we get that problem, once again I'll give you the reference in this here. Okay. Option number two. Intangibles. Treating it as intangibles. That's it. And then claim depreciation. Both alternatives are allowed. That's it. First alternative I always considered better is 37. Claim it as deduction. Non-compete fee paid is a business expenditure. You can claim it as deduction. Next. Next. Now look at the buildings. Look at the buildings. I told right, by the way, in income tax, what is a block of asset first of all? One or more assets falling in same category and also carrying same rate. They all be grouped into a single block. We have four categories, right? Intangible, building, furniture, plant and machinery. Am I right? We have only four categories of assets. Depreciable assets are broadly into four categories. Intangible, building, furniture, plant and machinery. Suppose I bought a phone. It's a plant and machinery. I bought a car. It's a plant and machinery. Air pollution control equipment I bought. It's a plant and machinery. Now, car, phone, air pollution control equipment. All these three comes under same category, plant and machinery. Can I add all these three, total it, and then create a single block? No. You should see the rate applicable. Second condition, what you should see? Rate applicable. Look at cars are eligible for what rate of depreciation? 15%. Whereas air pollution control equipment, that is eligible for what rate of depreciation? 40%. Even though pollution control equipment, cars, everything, mobile phones, all these items comes under same category, but they are carrying different rates. Therefore, I should again divide them into multiple blocks. You see, plant and machinery, if you see, there are totally 5 blocks are possible. In plant and machinery, how many blocks are possible? 5 blocks. See, this table is also there in ICA book. But in that ICA book, no, everywhere they said block. That's wrong actually. The way of presentation, what they did is wrong. Conceptually, they were correct. Sentences and all they gave correct. But they just block 1, block 2, block 3, block 4, block 5, like that they gave you for each item. That's actually wrong. Because that will not satisfy block definition. In income tax, in section 32, if at all you did IT return filing, yes or no, you will not find computer block. You will not find, yes or no, pollution control equipment block. You will find plant and machinery 40% block. Plant and machinery 15% block. Plant and machinery 20% block. Plant and machinery 45%, 30% block. Yes or no? We will not call them as computer block, mobile block. No. All are plant and machinery blocks only. Just that rate will be different between each of them. One is plant and machinery 15% block. Another one plant and machinery 40% block. Another 30% block. Another 20% block. Furniture 10% block. Buildings 10% block. I hope you understood. In exam also you should present in the same way. Don't worry, we are computing the problems. There you will understand better. So look at. So assets falling. Now for example, you see airplanes, pollution control equipment, life-saving medical equipment, renewable energy devices. Okay. Renewable might is not renewal, or you can call renewable energy, no problem. Okay, that sentence also, that is also absolutely correct. So electric vehicles, which may be fully battery based vehicle or fuel cell powered vehicle. Fuel cell powered means plug-in hybrid. That's actually called as plug-in hybrid. Means there is a car, for example, you can put fuel and then run the car, or you can also charge it and then run it. Both. It functions as a both. Plug-in. That's why it's called fuel cell powered. So fuel powered, cell means battery powered. Both are. Yes or no? Windmills, which are specifically designed devices that runs on, special devices that also runs on windmills. Any special devices including generators, pumps, which runs on wind energy, entire wind related equipment, they're eligible for what rate of depreciation? 40%. There is only one condition. For all renewable, for entire wind sector, is there right? Wind related one, is there right? They should be installed on or after 1st April 2014. Before 1st April 2014, they are coming under 15% category. They all come under what category? 15%. Renewable energy devices, windmills installed before 1st April 2024, they all come under which rate ma? 15. Only from April 2014 onwards, to promote wind sector, renewable energy devices, all that, they were given higher rate of depreciation, 40. Clear? Then energy saving devices. So all energy saving devices, pollution control devices, everything that is helping the climate, environment, they all come under what rate of depreciation? 40%. Higher depreciation, just it's an incentive. Higher depreciation. Then computers, including computer software, computer printer, and UPS. Okay, so all this they are eligible for what rate of depreciation? 40. Remember, computer printer is different from photocopier. Photocopier means nothing but Xerox machines. Suppose if they say in question Xerox machine, that's not eligible for 40. That won't come under computer ma. That will naturally come under again 15. Any other plant and machinery. Any other plant and machinery like ACs, mobiles, bikes, inverters, generators. Again remember, generator runs on windmill is 40%. Generator runs on normal energy. Yes or no? That's again 15%. Clear? Next, in direct tax, you have to remember all this. Okay? Again, the more you repeat, the better you remember. You don't have to fear about I have to remember this, I have to remember this. No, don't struggle. You remember naturally. Next, if at all you are buying any books like law books, Income Tax Act, Bear Acts, all that, practicing says, especially practicing lawyers, they all have, you see lawyer offices, so many books will be there in the cupboards, full of books, the cupboards. Each book will be costing 2,000, 3,000, 5,000, 10,000 publications. Yes or no? Big guidance notes and all will be there. So books are all, whether it's an annual book or non-annual, okay, it doesn't matter. Even if the books which are used in lending libraries, they're all eligible for what rate of depreciation? 40%. So a company generally might buy all this. A company will have a books for research and development department. They buy computers for R&D or normal department, whatever. They buy laptops and all, printers and all for various reasons. Yes or no? All of them total it. Group them into a single block. Values you total it. That's a block. That's a plant and machinery 40% block. Plant and machinery 15% block. Plant and machinery 20, plant and machinery 30, plant and machinery 45. Only 5 blocks are possible. That's it. Within plant and machinery, how many sub blocks are possible? 5 blocks are possible. Now, furniture, like furniture and electrical fittings, fans, wiring, sockets, they all come under electrical fittings. They all come under what rate? 10%. First time when you install, see, first time you are doing interiors completely for the particular building. You might have bought one switchboard, for example, might cost somewhere 2,000 rupees. We should capitalize 2,000. No. For entire building put together, how much you spend? 1 lakh I spend, sir. That 1 lakh will be called as electrical fitting. So fans, lights, everything put together, we should total it, and that total electrical fittings we should capitalize. Later on, if you're replacing some switches, some repair, some switch got damaged, you replaced it. That's a replacement of one-odd part. It's eligible for deduction under section 37. You should not capitalize it. Are you clear? Materiality concept can be applied here. Materiality concept can be applied here. Clear? Simple. In Companies Act, in your books of accounts, if you capitalize a particular expenditure, if you capitalize some purchase of some asset item, under income tax, add it to concerned block. You charge it to P&L there. In income tax also you charge it to P&L. Clear? That's it. Buildings. Now again, buildings, Normal buildings, nothing but non-residential buildings. What are non-residential buildings? Factory, yes or no? Showrooms, all these. They are liable for what rate of depreciation? 10%. Buildings used for residential purpose like employee staff quarters, they are depreciable at what rate? 5%. But in most of the books, in most of the problems, though building is used for residential purpose, yes or no, they are not taking 5% logic, they are only doing 10% logic. They are only applying what logic? 10% logic. 5% logic is used at one place. I will tell you there. Okay, I think I can say, I think explanation 5 to section 43 subsection 1. Explanation 5 to section 43 subsection 1. You will find another explanation table. You will find 43.1 cost. You can see here, this one, this table. Okay, there you will understand explanation 5. Okay, explanation 5. There I will discuss about that 5% rate logic. Next, again, come back. That's it. So these are the rates of depreciation. And again, buildings which are of temporary structures. Temporary structure, again, building which is eligible for what rate of depreciation? 40. Buildings which are used for water supply treatment, water supply or treatment, and used for business of providing infrastructure facilities. If at all you are using a building for providing infrastructure facilities, for example, on the national highway, small buildings will be constructed, toilets, all that. Yes or no? They are all for infrastructure facility support. Those buildings are eligible for what rate of depreciation? 40%. Metro building is there. Metro rail will be there, right? Building is there, right? That's eligible for what rate of depreciation? 40%. Clear? But don't worry, all these are, you don't have to remember. Certain rates only are important. I'll just highlight those rates. Intangibles obviously 25, buildings 10, furniture 10, and even in this entire this plant and machinery 40% block. Plant and machinery. Then again, of course, ships, vessels, all that you have to take it to 20% block. Remember, aeroplanes and engines is 40%, whereas ships is 20%. Mobile phones, cars, all this is eligible for what rate? 50. Now, there is one exception to cars. Generally, cars are eligible for what rate of depreciation? 50. But if at all you are using that car for leasing, car hiring, car leasing, you are running it as a commercial vehicle, then you are eligible for 30% rate. If at all you are using it for your business purpose, for transporting, for conveyance of director, yes or no, for business purpose, official purposes you are using, not on a hire and leasing basis, they are eligible for 15 only. But if at all you are using them on hire, you are leasing them and all, they are eligible for what rate, 30%. So buses, lorries and taxis which are used for hire, they are eligible for what rate of depreciation? 30. Now, again, suppose if you buy a car between 23rd August 2019 to 31st March 2020, and if at all you are put to use by 31st March 2020, any car, they are eligible for what rate? 30. Now, second point, you see, bus, lorry, taxi, generally if at all you are a road transport company, you are buying buses, eligible for 30% depreciation. But if at all you bought them during 2019 to 31st March 2020, during this period, if at all you bought, they are eligible for higher rate of depreciation, which is 45%. 99% possibility they will not test this date concept. They will not be testing. 99% they will not be testing. So you don't have to worry. Generally, motor cars eligible for what rate of depreciation? 15. Bus, lorry, taxis eligible for 30. That's it. Taxis means what? Cars which are used on hiring and leasing. That's it. You can simply call them as, you can simply classify them under 30% category. Clear? That's it. Now again, come back to, so what is a block? What is a block? First of all, why do we went there? We should calculate depreciation on a block basis. Block of asset approach is what we follow. That too, we should calculate depreciation only on end of the relevant previous year, that is 31st March, provided two conditions are satisfied. One, there must be at least one asset in the block. Block should be there as on 31st March. At least one asset should be there. Block should be there. All the assets in the block should be there. There is no such condition. All the assets should be there. There is no such condition. If block is there, that's enough. And value is there. Written down value exists. So as on 31st March, block is existing. Written down value is positive. You can claim depreciation. Either if block does not exist or written down value does not exist, you cannot calculate depreciation. Now block means what? Block of asset means one or more assets falling under same category and carrying same rate. Group them into a single block, total them and then add it into a particular block and then depreciate it. Okay, how to depreciate, we'll discuss it later. Now, so one or more assets falling under same category. What do you mean by same category? There are 4 categories: intangible, building, furniture, plant and machinery, and rates. We already saw the rates. So I hope you understood how to classify as a block. Yes or no? That's it. How to classify, how to divide assets into multiple blocks. We have a problem also, we'll do that. Okay, that's it. So with this we understood the basic concept of depreciation. So in the block, first condition 1, there must be at least one asset in the block. What do you mean by block? Condition 1 we understood. So one of the condition to claim depreciation is block must be there as on 31st March. What do you mean by block? We understood. Block must be there means also we understood. For example, I bought a mobile phone, I bought a laptop. I bought 10 laptops and I also bought some pollution control equipment. Okay, so 10 laptops I bought, some 10 years back I bought, some 5 years back I bought. 2 years back pollution control equipment I bought. This year what happened is, except one laptop, rest all other I sold. Now pollution control equipment 40% block. Laptop is also 40% block in plant and machinery. So 5 years back when I bought 10 laptops, I created block for the first time. Plant and machinery block 40% I created. 5 laptops into 50,000 is equal to 2,50,000 I added in the block. And every year I am depreciating. 2 years ago I bought pollution control equipment. I added that into the same block. Pollution control equipment is 5 lakhs the cost. I added in the same block. And again, this year what happened is, I sold that equipment, out of the 5 laptops, 4 laptops I sold. Only 1 laptop is with me. As on 31st March, block existing or not, tell me. Yes. Condition 1 satisfied, over. Now we need to discuss condition 2. What is condition 2? There must be written down value in the block, correct? There must be written down value in the block. If the written down value is also there in the block, positive, happy. Now just compute the depreciation as per computation format, over. Depreciation computation is over. That's it. This is what the provision is all about. Clear? We'll take a small break and then get back and then continue with WDV discussion. Clear? Yes. Let's continue the depreciation concept. Condition 1 we understood. Now we need to look at condition 2. What is condition 2? So to be satisfied as on 31st March of the relevant previous year, what is the condition 2? There must be a positive written down value. There must be value, nothing but positive value should be there. It should not be negative. Now what do you mean by written down value? You know, like I told, right? For example, there is a block called block plant and machinery 15%. There is a block called a plant and machinery which carries 15%. Suppose I'm starting my business for the first time. Okay, I'm starting my business for the first time. So will there be any opening WDV of the block? 0. Generally opening WDV when I'm starting the business for the first time, just now I'm buying the assets, opening value will be 0 generally. To the opening value, suppose if it is existing business, opening value will be brought forwarded from previous closing value. Okay, so opening WDV plus what we need to add, like in the opening WDV, what we will add? Additions made during the year. You know, more clearly the format is explained here in much more better way with clear wordings. This is actually called as depreciation computation format or block of asset format. You can call them as both, any of them. So first, opening balance. What is the first one? Opening balance of the block as on 1st April of the current previous year, which will be exactly the closing WDV of the last year. Now in exam, they'll give you sometimes exclusive depreciation question will be there. In exam, they'll give you WDV as on. For example, what is the relevant year right now? 25, 26. They will give you WDV as on 31st March 2025, 10 lakhs that's it. 31st March 2025, WDV as on 31st March 2025, 10 lakhs that's it. What you will do, opening value here directly will bring what? 10 lakhs. Wrong. WDV as on 31st March means, if they simply say WDV as on 31st March, we should take it as before depreciation. We should take it as what? Before depreciation. See, suppose in the bracket they clearly mentioned after depreciation, then no problem. If they clearly mentioned WDV as on 31st March of the last year within bracket after depreciation 10 lakhs, then as it is you bring it. Suppose if they do not mention before depreciation, after depreciation, nothing they mention, it is assumed that it is before depreciation. Are you clear? This is one important point that you should remember. Because in income tax, WDV means by default before depreciation. Because you calculate depreciation on WDV. You calculate depreciation on what? WDV. Once from the written down value you calculate depreciation, what you get is not again WDV, closing balance. What you get is actually called as closing balance. That closing balance of the block will be the opening balance of the block in the next year. You see, we don't call it as opening WDV. We call it as opening balance of the block. Clear? So closing balance is different, WDV is different. WDV of the block as on 31st March, if they mention, whether is it before depreciation, after depreciation, clarification is not there. We assume that it is before depreciation, which means you need to calculate depreciation. Let us assume 1.5 lakh depreciation in that year. Then opening value will be what? 8.5 lakh. Most important thing you should understand. If they clearly mention after depreciation, happy. If they do not mention, you need to take this assumption. It's not even assumption. That's how the drafting was. Okay. Now, so opening WDV, or you can also call it as what? Opening balance. Now to that, what you need to add? Additions. What do you mean by additions? Additions means some asset we got. Some asset we got here. Okay. Very simple. A new asset coming into, factory or the building, so that I can use it for business or profession. So a new asset coming into picture. Last year we have only 25 assets. Now a 26th asset joined. Addition means 26th asset joined relating to this particular block. So assets acquired. What is it? Asset acquired during the previous year. And if you observe, we didn't use the word installed. We just used the word what? Acquired. You just acquire it, add in the block. That's it. You acquired the asset, add in the block. Now, what I need to add in the block? Actual cost I need to add. What I need to add in the block? Actual cost. So for example, opening balance is, let us assume it is 10 lakh. I acquired the asset. I purchased the asset. Or sometimes what happens, in exam they'll give you conversion of stock in trade into capital asset. Suppose the company is a furniture vendor. It's a furniture manufacturer. They sell furniture to outsiders generally. Now the company has a corporate office. In the corporate office, some sofa set is there. It got damaged. Now they've thrown that sofa. Now tell me, for the furniture entity, generally sofa means what? Stock in trade. But the sofa that is there in the corporate office, what is it? Fixed asset. They're using it for their own business, right? That's a fixed asset. Now that particular sofa will be already part of furniture block. It's already part of furniture block. Now that sofa they're discarding. Now whatever they want to buy new sofa, where they will buy? They are the furniture manufacturer. So whatever inventory they have in the godown, they just call it to the office. Okay, bring one sofa set here. Now what is happening here? Stock in trade that is there is now converted into a depreciable asset, nothing but capital asset. You are converting stock in trade into capital asset. Technically, what will happen? You should have sold that goods to customer. You have sold the goods to, you should have sold that sofa to customer. Let us assume the market value of the sofa is 1 lakh. Market value of the sofa is what? 1 lakh. So technically you will sell it to the customer at 1 lakh rupee. But that 1 lakh rupee you are now foregoing and then bringing it into the capital asset, depreciable asset. Now at what value I should record in the block? 1 lakh. Market value, not the cost. You will not record it at what? cost. You will record them at market value. Are you clear? That is there. So what do you mean by actual cost? There are different circumstances. You can see actual cost in some situations. Okay, so in that explanation 1A, conversion of inventory into capital asset, how much amount to be added to the block? You see very clearly every word I'm telling you, every word I've selectively chosen. I did not simply put the heading actual cost. Actually, you see, I say book, actual cost heading will be there. What is actual cost? That is a cost which is to be added in the block. So how much amount to be added in the block? Fair market value on the date of conversion. So that so far, if I sell to customer, I will get 1 lakh rupee, right? That 1 lakh rupee I will add it in the cost. Many times this adjustment is asked. Many times. Remember, this is not a case of capital asset converted into stock in trade. Again, remember, original form here is stock in trade. That is converted into capital asset. So fair market value you will record. Yes or no? You will add it to the block. There is one more adjustment. You're now bringing that. See, when you purchase this furniture, suppose you're a trader actually. You purchase furniture from Malaysia, you import and then sell it. Yes or no? When you purchase it, you recorded it as purchase expenditure in P&L. Now, direct that so far you're bringing it here and then adding in fixed asset. Double benefit you're claiming. You should offset the purchase, right? You should offset the purchase, right? What you should do? I already purchased, I claimed cost in expenses. Now I'm bringing it in fixed assets and again I'm adding in fixed assets. Double benefit. That's why what they say, 28 charging section. Conversion of inventory into capital asset. Market value is there, right? That is what we are adding in the block, right? That market value we will show it as revenue. That market value we will show it as what? Revenue. We will record it as sale in PGBP. We will record it as what? Sale. It's a deemed sale. It's a deemed sale. 28 charging section. Go to the charging section. You will find it. 28. Yes, you see 9th point you see in the charging section. Conversion of inventory into capital asset. The fair market value of inventory on the date of conversion to capital asset is taxable as what? Business income. Nothing but we have to add it to sale. I will once again discuss this in capital gains topic, which was asked in 2019 exams. Clear? It was tested in many more also, but for some wherever possible I gave the one time, like I just give one time only the reference, not every reference I gave. Every time it was tested, every reference I did not give. One time. Sometimes if it is, unless you should not ignore it, that time I'll give 2 or 3 times references also. That's it. So I hope you understood this adjustment. So actual cost means what? So actual cost means generally what is actual cost now? How much you pay for getting the machine. Suppose you're computing for block plant and machinery 15%. 15% plant and machinery block is what you are actually looking at. Whatever amount you pay for getting the machine, that's actual cost. Generally, if you pay something and then get it, that's actual cost. But there are some circumstances. Example this. Sir, I didn't pay anything. In my godown, the inventory is there that I brought and kept in the office. Yes or no? And using it for my business. What about this? That's why explanations were there. So there are various explanations which will give you what is meant by actual cost in different other circumstances. Sir, I purchased from manufacturer, sir. No problem at all. Directly you add it. But there are different some other circumstances. Through those circumstances, I got this. Sir, I got as a gift. What should I do? I converted my inventory into stock, inventory into capital asset. What should I do? Like this, there are multiple circumstances. In those circumstances, what is actual cost? That is where the explanation table comes into picture. That is where this explanation tables will be applicable. Okay, I'll come back to it when I'm discussing. I'll continue later that actual cost. So generally, so what is the format here again? Assets acquired. Actual cost of assets acquired. Actual cost means what generally? Purchase price paid. Suppose if at all the acquisition mode is mentioned under those explanations, then as per the explanation, whatever actual cost is there, that much you have to take. Be careful. Now sometimes they'll give you below in additional information. PGBP problem they'll give you additional information. There and what they'll mention, inventory has been converted into, capital asset. Okay, this transaction is not recorded in above P&L account. That's what they will mention. Now, sofa inventory is converted into depreciable asset. 1 lakh is fair market value of the sofa. Now, what you should do, when you're computing PGBP income, market value and conversion, whatever is there, that market value you should add it to sales, right? Manually, you treat it as income in the PGBP computation. Further, this 1 lakh, the respective block is there, right? In that you add it and then recompute the depreciation as per how we are going to compute. Understood? This is how we have to think. Some students, what they do, when this adjustment is given, this transaction is not recorded in above P&L. What they will do, they will absolutely remember this point. Okay, we need to add it in the block, but they'll forget the point of recognizing that. They forget the point of, okay, we should treat it as sale also, simultaneously. This point they'll forget. Automatically, again, PGBP computation is wrong. Clear? Now look at. Now I need to add it. Now when I'm adding in the block, for the sake of exams, for the sake of our exam purpose, divide this asset into 4 categories. Divide that addition into 4 categories. Look at one category, last one, capital repairs incurred. In exam, they'll give you SSC spent capital repairs on machinery. Some 1 lakh they'll give you. You thought it's a repair spent capital expenditure. Your logic, everything is correct. You might think it's a capital expenditure, no deduction. You didn't claim deduction. Very good. Who will add that in the block? Are you getting it? You need to remember that current capital repair. You should remember specifically. Of course, you will not claim deduction. You're good at that. But you forgot to add it in the block. So you need to remember capital repairs incurred. Yes or no? We already discussed under 3031. Add it in the block. Respective block add. Because that is also an addition. Remember. Yes or no? Then you acquired the asset, sir, but not installed. Doesn't matter. You add it in the block. You just add it in the block. See, remember, there is a difference between claiming depreciation, adding in the block. I'm only telling you to add in the block. I'm not asking you to compute depreciation on asset not used. Somewhere you might have studied in CA Inter, asset not installed, no depreciation, yes or no? Immediately that point strike you, yes or no? I'm not talking about depreciation computation. Right now I'm only talking about additions. Right now I'm only talking about additions. When I reach depreciation computation stage, that time I'll tell you all your installation logics. Clear? Then, fine. So one is capital expenditure incurred, yes or no, on some plant and machinery buildings, which is not deductible under 30 to 31, but to be added to block, we need to add that. So look at in the exam whether this point is there anywhere. Or if you see anywhere, you need to strike immediately, this format should strike you. Second one, asset acquired but not put to use. Still add in the block. No change at all. Because what we are adding is assets acquired. In that block, if an asset comes, that's it. Add it. Are we using it? Are we not using it? That's a secondary question. First question, add in the block. Clear? Sir, assets acquired, sir, and also used. Assets I acquired and also used it during this year. This year we acquired the asset. This year only we have used it also. Then what should I do? Same, add it here also. But when you're adding, split that into 2 categories. Assets used for more than or equal to 180 days. Assets used for less than 180 days. Like, what is the cutoff date? 4th October of the relevant previous year. The cutoff date is what? 4th October relevant previous year. Take calculator, 4th October onwards. 31 days in October minus October 1, 2, 3 eliminate. So which means 28 days in October. So 28 days in October. November 30, December 31, January 31, Feb 28, March 31 is equal to 179 days. If an asset is installed, if an asset is put to use, installed, ready to use, nothing but on 4th October or later in the relevant year. If you install an asset on 4th October or later, it can be used maximum for how many days? 179 days. It cannot be used for 180 days. That's why the cutoff date 4th October is relevant. If it is a leap year, 5th October. If it is a leap year, 5th October. Don't worry, you are doing problems based on previous year 25, 26. 25, 26 is not a leap year. So now 2026 exam, you remember 4th October cutoff date. That's enough. Because for you the problems will be based on 25, 26. 2020 was leap year. 24 was leap year. Next leap year was 28. So we don't have to worry about the 5th October concept. Are you clear? So it is 4th October which is important. Next. So 4th October based upon the installation date. Okay, suppose I bought 3 mobiles. 3 mobile or 5 mobile phones I bought. 3 mobile phones I activated on or after 4th October. These 3 mobile phones put together cost is 3 lakh. I will add in the second line. If remaining 2 mobiles cost put together is 3 lakhs, that also, then I will add them in the first line. Then I bought some 2 spare mobiles, box intact. I have not even opened and switched on. Okay, that is 1 lakh. Asset acquired but not used. Yes or no? Then I furnish. Then some other asset is there. Some other asset is there. I mean, where I incurred capital expenditure. Getting it? So let us assume that is 50,000. I just spent capital expenditure. That's it. So total additions value 6 plus 1, 7, 7.5 lakh. Like this you need to calculate. Then what you get? Gross value of the block. What you get is gross value. It is not written down value yet. That is not a WDV of the block. It is just the gross value of the block or gross block value. So what is gross value of the block? Opening plus additions is equal to gross value of the block. Okay. In our example, 10 plus 7.5, 17.5 lakh. Are you clear until now? Until now you're clear? Now less. From that you need to reduce. Not only addition, sometimes deletions also will be there. I bought 5 mobiles and also some capital expenditure I incurred. And 1 asset acquired but not used. All these are additions. Simultaneously, parallelly, we also have deletions, subtractions. We also have deletions. Okay. So deletions are what? In the same block, there is something called old car is there. We have. So I am talking about plant and machinery 15% block. So there is a old car. Okay. Nice customer I got. I want to sell this car off from long back. Okay. It was a 10-year-old car. Let us assume, which is used exclusively for business. From last 10 years, we are exclusively using it for business. I sold it for 2 lakh rupee. I sold it for what price? 2 lakh rupee. Reduce the 2 lakh. That's it. Whatever amount you receive, you should reduce. In exam, to confuse you, WDV value of this car. WDV value of this car is just 1 lakh. They'll give you that information just to confuse you. You don't consider that because in income tax, we are not identifying asset wise. We are identifying them block wise. Okay. When you are adding in the block, each and asset value is relevant. Once the asset forms part of the block, it loses its identity. The asset once forms in once part of the block, the asset will no more have a separate identity. It will not have a separate WDV. Please remember that. The asset will not have a separate WDV. Now once I bought 5 phones, after 2 years, what is WDV of one of the phone? How much is the WDV? I don't know. I only know block WDV. Plant and machinery 15% block WDV value only I know. I don't know for each mobile what is the WDV, because we don't calculate WDV mobile wise, asset wise. We calculate WDV block wise. That's why when a part of a block is sold, amount received will be reduced here. What you will be reducing? Amount received. Are you clear? Look at money received or receivable. Okay. In respect of any part of the block which is sold or might be discarded or it might have been destroyed. Yes or no? During that, you see here, money received on destruction. When the asset got destroyed, why will I get money? Insurance compensation. Insurance compensation. For example, a mobile got broken. Luckily, the mobile is insured. It's a business asset. So insurance company, sir, that model is discontinued, sir. I won't pay you I won't replace the phone, but I'll do one thing. Market value of the phone, I'll replace you. New phone you can buy. They paid me 50,000. Still, I received 50,000, right? Even though there is a destruction, I received, right? Whatever I recovered, this cost I didn't incur, no? Am I right or not? Originally, I spent 1 lakh on the mobile. Now I am recovering 50,000. Technically, how much cost I actually incurred? 50. Depreciation should be claimed only on that. 50 technically. But earlier and all, I claimed on 1 lakh, all that. Now I recovered 50. So reduce that 50 from the block. Automatically, retrospective effect is given. Able to understand? So amount received, you reduce it, because originally when you purchase, you added everything, you added. Now you are receiving that much amount. You are receiving some amount. To that extent, you didn't incur the cost. When you are recovering later, to that extent, you didn't incur the cost. That's how this principle is working. Clear? So amount received, reduce it. Simple, simple. Don't need to look at all this logic. Simple. Amount received on transfer of part of a block. And you know very well, transfer includes sale, exchange, destruction, demolition, all that. Yes or no? So amount received on transfer, reduce it. Now here there is one point which is there within bracket. This is slump sale related. I will discuss later. This point I will keep it pending. Okay. This is slump sale related one ma in capital gain. Slump sale is also one of the important provision. Okay, we'll discuss this in slump sale point. So reduce whatever the part of a block. If you observe, I'm only talking about part. I'm not talking about full block. You know very well the reason. First condition, if full block is sold, block itself is not there. When block itself is not there, why will I compute depreciation? Correct, huh? Yes or no? So only when part of a block is sold, I will compute still depreciation. Now part of a block is sold for 2 lakhs ma. Let us assume part of a block, I will take another figure. Let us assume 5 lakhs I sold it for. What is it? I sold it for what? 5 lakhs. Part of a block only I sold. Sir, what do you mean by part of a block? Out of 10 assets, 9 assets sold by me. Still it is part of a block sale only. Am I right? What do you mean by full block is sold? Full block transfer means what? You should not even be left with a single asset also. Even if single asset is not there on 31st March, then you can consider that as full block is sold. Here 9 assets are sold, still it's a part. Anything which is not 100% is part. Am I right? So part of a block is sold for 5. Now tell me, WDV of the block before depreciation, how much it is now? 17.5 minus 5, how much it is? 12.5. Now this is what the second condition is talking about. WDV of the block should be there. It should be positive. As on 31st March, you should satisfy 2 conditions. Condition number 1, there must be at least 1 asset in the block physically exist, or virtually, intangible we call virtually exist. 2, there must be a WDV in the block. If the WDV is positive here and block is also there as on 31st March with you, it is continuing for the next year, calculate depreciation. If this value by mistake is turning negative, no more block, condition 2 fail, you can't calculate depreciation. When you cannot calculate depreciation, what you should calculate? Section 50, short-term capital gain or short-term capital loss. What you should calculate is short-term capital gain or short-term capital loss. Now let me discuss 2 examples on that. For example, there is a opening WDV, okay, 10 lakh. Additions during the year, let us assume 5 lakh. Okay. Case number A, full block sold. Full block sold at 5 lakh. Case number B, full block sold at 20 lakh. Case number C, part of a block sold at 5 lakhs. Case number D, part of a block sold at 20 lakh. Compute depreciation or capital gains as a case. Maybe one exclusive question of 4 to 6 marks question can come like this. An exclusive question on depreciation like this they can ask. Now look at, let's apply the same logic. I will start with the block. Okay, first case scenario. First case, full block sold, they said. As on 31st March there is no block, which means for first 2 cases we are very much clear. Condition 1 failed. If condition 1 failed as on 31st March, I cannot calculate depreciation. When I know I cannot calculate depreciation, obviously what I should calculate? Capital gain or capital loss. Am I right or not? Now when I'm computing capital gain or loss, what is the computation mechanism? Sale minus cost. Sale minus cost, am I right? Sale value how much here it is? 5 lakh. Yes or no? Sale price how much here ma? 5 lakhs minus cost. For depreciable assets, what is cost? Gross block value. What is cost? Gross block value. What is gross block value? Opening plus additions. So opening plus addition how much? 15 lakh. 15 lakh worth of block, I sold it for 5 lakh, which means 10 lakhs is a short-term capital loss. 10 lakhs is a short-term capital loss. You understood until now? See, capital gain computation format is nothing but reverse format. Reverse of this. First, right sale 5 lakh. Then minus opening value plus additions. When you are computing capital gains, you should compute in mind first. Capital gains applicable. Oh, if capital gains applicable, I have to reverse the format. First, I should put amount received. 5 lakh minus. I should reduce the block value. What is block value? Whatever opening value plus additions you might have made. No. Now all that is sold. All that entire thing is sold off now. Yes or no? So definitely when you receive 5 lakhs for opening value worth of 10 lakh plus additions worth of 5 lakh, total 15 lakhs worth, you sold it off and got only just 5 lakhs. Have you made a loss of 10 lakhs or not? Exactly. That's what short-term capital loss. Over. Are you clear? Case scenario 2. B. Case B. Sale value 20 lakh minus gross block value 15 lakh. Then you got a profit. That profit is called as short-term capital gain. That profit is called as what? Short-term capital gain. Don't worry, in capital gains topic, we exactly gave this table format, everything clearly under section 50. Okay, next. Sir, for example, part of a block is sold, sir. Okay, part of a block sold. WTV opening value how much? 10. Additions how much? 5 lakh. Correct? Huh? Gross block value how much? 15. Minus part of a block is sold for what price? 5 lakh. Hello? Remember the example? 5. Now, what is the WTV of the block? 10. Now, my doubt is, should I compute depreciation or capital gain? This is the question. As on 31st March, part of a block existing or not? Yes. Value existing or not? Yes. I will calculate depreciation further. I will not calculate capital gains here. Are you clear? Then case number D. Case number D. Opening value 10. Additions 5. Gross block value 15. But amount received on part of a block sale is 20 lakh. Value becoming negative. Value, WTV value cannot be negative. You can only bring it to 0. Is block existing as of now as on 31st March? Yes. Is value existing positive? No. Again 32 will not apply. Check for capital gains. Now here I received 20, no, but only I can reduce 15. I can only reduce up to 15 because block value is only 15. So I can reduce the block only up to 15. Block is there. But 20 lakh value sale amount I can't reduce here because the value is not sufficient. Clear? Therefore, I will only reduce up to whatever value available. Then the balance value, what you will do? It's a profit already. It's a profit. Array, full block itself is 15 lakhs here. Part I sold for 20. So even if I set off with full block value, still I made a profit of 5 lakh. That's a short-term capital gain. What is it? It's a short-term capital gain. So the thumb rule, in case full block is sold, either you get short-term capital gain or short-term capital loss. Sir, I sold only part of a block. Either you get depreciation or you make short-term capital gain. Is there a possibility of short-term capital loss on transfer of part of a block? No. Obviously, when I sell part of a block, is there a short-term capital loss possible? No. Short-term capital loss is not possible in case of part of a block sold. Why? Short-term capital loss when you will get when full block is sold. Here, part of a block I sold for a value less than gross block value. Therefore, some more value left. Block is also there. I will calculate depreciation. There is no concept of short-term capital loss in case of part of a block sold. Thumb rule. Clear? Until now, clear, easy, everyone? That's it. So now, once you reduce amount received, that's why I clearly mentioned here what? Amount received in respect of part of a block sold. Yes or no? Reduce it. Now here you see value of step number 4 cannot exceed. Here in our example, if you remember, just 1 minute. In our example, 10 lakhs opening, 5 lakhs additions, 15 lakh. Here sale value is how much ma? 20 actually, correct? 20. But here there is one line. What they are mentioning? Step 4 cannot exceed step 3. So 20 is there. So I cannot go beyond 15. So 15 lakhs only will reduce. Therefore return on value will be 0. When the return on value is 0, there is no question of depreciation at all. When the return on value became 0, there is no question. Actually, I have received 20 lakhs you. More than gross block value. You already made a profit. First tax it. You already made a profit. First tax it. Under capital gains, that extra 5 lakh, whatever is there, it will be treated as short-term capital gain. On depreciable asset, the gain or loss is always treated as short-term. maybe the asset whatever you sold, right, that asset might have been there with the entity for more than 24 months. It might be there with the organization for more than 24. The asset might be long-term capital asset, but the gain or loss is always short-term because of the deemed declaration given under section 50. Section 50 says the gain or loss is always short-term. That's it. Okay, the asset may be long-term. There is a very, very solid logic behind this. Why? Once an asset comes in the block, asset loses individual identity. Am I right? When you sell that asset from the block later on, it is always treated as not sale of mobile phone. It is always treated as sale of part of a block. We don't know which part you are selling. I don't even want to know which block you are selling. I don't even want to know which block you are selling, which asset you are selling. It's a part of a block sale. I don't know whether it's a long term or short term. I don't want to take all that headache. Straight away classified as short term. That's it. Clear, all of you? The logic behind it you understood. So now again, let's continue with case number C. So for example, opening is 10 lakh, additions is 5 lakh, totally 15 minus, let's assume 5 lakhs is the sale value. 5 lakhs is sale value. So then what is the value available for depreciation? 10. Now I need to calculate depreciation on that 10 lakh. Now here for computation of depreciation, I'll take a slight different example. Originally, what are the values we thought, ma? Opening value 10 lakh. Am I right? Additions which are used for more than 180 days, 3 lakh. Which are used for less than 180 days, 3 lakh. And some assets acquired but not installed, 1 lakh. Then some capitalization is how much? 50,000. Totally 7.5 lakh. Now part of a block is sold. There are so many assets in the block. Number of assets are, let us assume 10 to 12 were there. 10 to 12 assets are there in the block. We sold some 7 or 8 assets. Part of a block we sold. Let us assume we sold it for 7.5 lakh. Part of a block was sold for what price? 7.5 lakh. Now what is the value available again? What is the written down value? 10 lakh. This value is called as value available for depreciation, or simply called as WDV of the block as on 31st March. WDV of the block as on 31st March. To be more specific, WDV of the block as on 31st March before depreciation. How much is that? 10 lakh. Now let's calculate depreciation. So okay, here itself I can allocate. So what is the value left, ma? 10 lakh. Correct? WDV of the block, how much, ma? Left 10 lakh. Now I need to calculate depreciation. How to calculate depreciation here? That's the question, because in this 10 lakh, no, new asset might be there, old asset might be there. Who knows which asset is there? Yes or no? Once this 10 lakhs comes, this is 10 lakhs is block value, WDV of the block. Now I need to calculate depreciation. Now you need to allocate this 10 lakhs based upon this year block transactions. In the block, some transactions happened, right? Additions happened, deletions happened. Based on the transactions happened, you should allocate this value. When you are allocating this value, sale is there, no? Irrelevant for you, because this value is arrived already after sale. After sale only this 10 lakh value arrived. Do you all agree with it? Now you see, I clearly mentioned first allocate the value to assets bought but not used. How much worth of asset in this year we purchased but not used? How much worth? Remember? 1 lakh. Assets acquired but not used. How much is the worth, ma? 1 lakh. So first I will allocate 1 lakh here. Are you clear? Then second, I will allocate to assets which are used for less than 180 days. Which are used for less than 180 days. How much is the asset worth I purchased? Oh, less than 180 days. How much is there? Only 3 lakh. For the sake of convenience, capital repairs we incurred, no? Capital repairs we incurred, no? This 50,000 rupees. I will assume this capital repair is incurred before 4th October. Oh, sorry, after 4th October. I assume that it is spent after 4th October. Why? Because even whenever you're adding something in the block, either you have to add it under used, more than 180, less than 180 category, or not used category. Getting it? So capital repairs incurred, just like that you can't add it. You need to split that between more than 180 and less than 180 days. Because if the capital repairs are spent, incurred, and asset become useful already before 4th October, then allocate that under more than 180, more than or equal to 180 category. If not, less than 180. In this problem, I assume that 50,000 rupees worth of capital repairs we spent. No, that is we spent after 4th October, I assume. So which means total less than 180 days, how much value is there? 3.5 lakh. Am I right? Hello everyone? 3.5 lakh. Now here you see at last balancing figure. What is balancing figure? Out of 10 lakh, 1 lakh allocated here, 3.5 allocated, 4.5 is allocated. Balancing figure left is 5.5 lakh. Am I right? Hello everyone? Now allocation is completed. Depreciation not yet computed. Now we should compute depreciation. Now on the first allocation where asset is purchased but not installed, since you didn't install, you cannot claim depreciation on this value. You cannot claim depreciation on this value but not used. Therefore depreciation is 0. Yes or no? Asset used for less than 180 days, is that right? Asset used for less than 180, there how much you allocated? 3.5 lakh. Apply half rate. In this problem, what is the block rate? 15%. Half rate means what? 7.5%. What is the depreciation? 3.5 lakh into 7.5% is equal to 26,250. Are you clear? Then on this full rate, 15% is equal to 5,50,000 into 15%. How much? 82,500. 82,500. Now what is the total depreciation? Total normal depreciation, how much? A plus B, only these two, correct? Is equal to how much? 26,250, 85,500, sorry, 82,500 plus 26,250 is equal to 1,08,750 is the total normal depreciation. Until now, whatever we computed is only normal depreciation. There is another concept called additional depreciation. I'll come back to it later. Until now, clear? Yes or no? The same example I'll continue for next year. Okay, look at the next year situation. I am talking about previous year 26, 27. Okay, already here, by the way, here 1,08,750. Let us assume this is not a manufacturing company. There is no additional depreciation. Okay, only normal depreciation is there. So now I need to reduce, right? 1,08,750. Am I right? What is closing WDV of the block? 10 lakhs minus 1,08,750 is equal to closing WDV is 8,91,250 as on 31st March 2026 after depreciation. Do you agree with this? All of you? Now the same value becomes opening WDV. Am I right? Opening balance. What is opening balance? 8,91,250. Am I right? Let us assume there are no additions this year. 0. Let us assume there are no deletions also. 0. If addition deletion is the same logic how we did for the last year. Yes or no? Now again, what is the WDV of the block? 8,91,000. 8,91,250. 8,91,250. Okay, this is WDV of the block. Same. First, no, these two you should add. Gross block value 891,250 will come. Gross block value minus sale value. Then what you get is WDV value. Am I right? Now minus depreciation. Again working note 1. This 8,91,250 I need to split into 3 parts. First one I should allocate to which asset? Asset acquired during the year but not used. We are doing for which year? 26, 27. Is there any asset acquired during the year? Is there any asset acquired during the year? No. Therefore the value allocation is 0. Second one, asset installed and used for less than 180. 0. Entire amount of balancing figure will come in 8,91,250. On that what depreciation is to apply? 15%, and whatever the value comes, that's it. Now here the confusion is, last year we bought an asset worth of 1 lakh which is not installed. Okay, we didn't claim depreciation in the last year. This year that 1 lakh value is represented in this 891. This year also it is not installed. This year also it is not installed. Still we are calculating depreciation here. The installation question for computing normal depreciation, the installation requirement and all will be applicable only for the first year in which that asset is purchased, or to be precise, first year in which the asset is added in the block. In the year in which the asset is added in the block, right? That year only I will look for installation date, not installed, all that. Next year, that asset loses identity already. Next year it is already part of opening value. You claim depreciation on the opening value irrespective of the fact whether asset in the opening value is actually used or not, doesn't matter. Are you clear? Indirectly, even though the asset is not at all ready for use, even though the asset is not at all ready for use, we are still claiming depreciation. Able to understand? We are still claiming depreciation because of computation defect it has. There is a defect in the computation format. For that reason, we are calculating like this. Clear? So once asset is added, the asset loses its identity. Only in this year it has an identity as addition, more than 180, less than 180, installed but not used. This identity is there only in the first year. Second year, there is no more identity for it. In this, for example, in 26-27, you bought another asset, installed but not used. That will get special treatment because that's a new asset in this year. Old asset already bought and forming part of opening value. No special treatment for it. Understood or not? This logic is completely different from additional depreciation logic. When I'm discussing additional depreciation, I'll tell you what is that logic again. Normal depreciation, everybody understood or not? Yes or no? So how you should calculate normal depreciation? Look at how you should calculate normal depreciation. I'll give one more example. Let's assume opening WDV is 20 lakh. Okay, assets acquired during the year, additions, I need to split them. Yes or no? It may be capital expenditure incurred or it may be a asset purchased, whatever it is. Okay, more than or equal to 180 days. Some 10 lakhs worth of asset I purchased. Less than 180 days. Some less than 180 days. Let us assume some 8 lakhs worth of asset I purchased. So gross block value is how much? 38 lakh. Correct? Huh? And now what I transferred is part of a block. Guess what? I transferred it for 30 lakh. Still, I have WDV left how much? WDV left is 8 lakhs. On this value, I should calculate depreciation. Clear? On this value, I should calculate depreciation. Let us assume this is 6 lakhs. Assets acquired and not installed. This is 2 lakh. Okay? Just I'm splitting this. Better idea. 8 lakhs. Now calculate depreciation minus normal depreciation. Working note 1. Always calculate working note 1. 8 lakhs. First I should allocate for what? 2 lakhs. Assets acquired but not used. What is the rate of depreciation? 0. Yes or no? And then second I should allocate for less than 180 days. Already 2 over. Balance left is 6 only. Moreover, here also less than 180 is how much? Here also how much it is less than 180? 6. Here also 6 is left. Here also I can allocate 6. Are you clear? For example, until no clear? Okay, for example, I'll slightly change this example. 31 lakh I will sale value. 32. For example, part of a block is sold for what price? 32 lakh. Everything else is same value. Just that part of a block is sold for 32. So 32 I sold it for. Then what is the value left? 6 lakh. Now I need to allocate that 6 lakh. Now again 6 lakhs I should allocate. First I should give priority for asset acquired but not used. Out of the 6 lakhs, 2 lakh I will allocate for asset acquired but not used. You know why I allocated 2 lakhs here? Because asset acquired during the year but not installed is 2. Second I should give priority to. Asset acquired during the year but used for less than 180. In our example, asset acquired during the year, installed, used for less than 180, 6 lakhs worth is there. But the problem I have is here, out of 6 already 2 I allocated. I am only left with what 4 lakh. I will allocate here 4 lakhs only. I will allocate how much here? 4 lakhs only. I'll tell you the logic behind this also. Very simple logic I'll tell you. 4 lakhs I will allocate here. Do you agree until now? Yes or no? Now on this half rate, 7.5%. Now balancing figure, already 2 allocated here, 4 allocated here, balancing figure 0. Understand the depreciation, computation, allocation. This is how you should allocate. Sir, asset acquired, sold, leave it. Allocation, blindly follow this logic. Now what is the logic behind this kind of allocation? Again, once an asset is added into block, it loses its identity. Okay. General scenario, when we are selling the asset from the block, option number 1, do we sell the asset which we purchased very recently, or do we sell the asset which we purchased very long back? Which one will discard? Generally, old assets I will discard. Now, out of 38 lakh worth of asset I have, okay, 32 lakh worth of old assets I sold. This asset is relatively, technically, logically belonging to old assets and new assets are new assets. So I'm allocating for new assets only. Do you understand? I'm allocating that value for which assets? New assets. Why? Obviously, you would have sold old assets only. Why new assets you will sell? So after sale, if at all still some value is there, that would have been belonging to new assets. On that logic, we are going like this. We don't want real facts there. I'm not bothered about real facts there. Probably, in reality, new asset is bought and that asset only we sold because it was not suitable for the entity. That doesn't matter. The real information doesn't matter. Allocation you should follow like this only. In exam, to confuse you, they might tell you a new asset bought during the year was sold. Some students, what they do, you know, are same asset bought and sold. Why should I add in the block? Because it's added in the block and immediately sold. So why should I add here in the problem? No, because it was purchased at different value, sold at different value. Remember, when you are selling, you see the value used there. Opening balance, additions, gross block value minus. They didn't tell asset sold. Which asset sold? They are not asking. Part of a block sold only. They are asking information. Yes or no? That part of a block might be new asset or might be old asset. Doesn't matter. Generally tell me. Which assets we sell? Old assets. General principle is we generally sell old assets. On that logic only department developed this kind of thing. So the act is written on the general presumption. Exceptional scenarios might be there. Sir, very rarely, exceptional cases, a new machine we bought, but it was not suitable for us. We sold it off. And again, we bought another machine there instead of that. So new machine bought in the year and sold in the same year. Now what should I do? These exceptional scenarios don't even consider when you're calculating like this. That's ignore. Follow block approach, follow depreciation format as it is. That's it. Clear? You understood how to allocate the value? So value, WDV value, first you should always allocate for assets acquired but not used. Okay, then if still value is there, allocate for less than 180. Still if some value is there, balancing figure it will come. That might include more than 180, opening, all that. That's unnecessary for you. The breakup is unnecessary for you. Value allocation is based on logic. That's it. It's not based on facts. It's always based on logic. Clear? So if you follow like this, you will never compute depreciation wrongly. It's impossible to compute wrong answer. Okay, because in most of the cases, if a depreciation tough question comes, this is where people confuse. Array, where should I allocate this? Opening first I should allocate, this one I should allocate, this one I should allocate, because in the question they'll make some confusion. New mission bought, last year we bought some mission, that is all they'll give you. So you'll be worried, where should I reduce that? Don't need to think of all this. Allocate first for assets acquired during the year but not used. Second, allocate for assets acquired, installed and used for less than 180 days during the year. Balancing figure. Over. Clear all of you? This is how you have to calculate normal depreciation. Now I hope you understood how to calculate normal depreciation. Everyone? Now, not only normal depreciation, we are also eligible for additional depreciation. We are also eligible for additional depreciation. How much additional depreciation we should calculate? How to calculate that? 2 minutes gap we'll take and then we'll discuss. Okay, I'll just stop this video because this entire video is regarding normal depreciation computation. Okay, that's it. Now, let's continue the discussion of additional depreciation. When you are computing depreciation, always remember depreciation working note should have 2 parts. Part number 1, you can see I numbered it. Part number 1, normal depreciation. Then part number 2, additional depreciation. Now, the logic of computing normal depreciation will not apply to additional depreciation. First point you should remember. What are the logic that is relevant for computing normal depreciation? That logic will not apply for additional. Additional depreciation has to be computed irrespective of the block concept. Irrespective of the block, asset, addition, deletion, leave it. That values are irrelevant. I gave separate values here, you see. Additional depreciation is calculated always on actual cost. It is not calculated on WDV value. It is always calculated on actual cost. Are you clear? Now, first issue. Who will get additional depreciation? If at all you are a manufacturer. Whether you're resident, non-resident, doesn't matter. If at all you are a manufacturer establishing factory in India. Okay. Manufacturer, simple. Or power sector. Power sector also additional depreciation they can claim only when they choose block of asset WDV approach. Then only. If at all they're following SLM asset wise approach, additional depreciation is not there for power sector. So if the SSC is engaged in manufacturing or power, on a power sector, then they are eligible for what more? Additional depreciation. You see here, additional depreciation is available. Eligible SSC. SSC engaged in manufacturing, production or power generation. These SSCs only are eligible for additional depreciation. And remember, they have given one clarification. Printing business is there, right? Business of printing and publishing is there, right? Business of printing and publishing is there, right? That is treated as manufacture or production. Further, in case of power sector, additional depreciation is allowed only if they choose block of asset method. Okay. Now, okay, fine. Who are eligible? We understood. Now, on what assets I can claim additional depreciation? Can I claim additional depreciation on furniture, buildings? No. You can claim additional depreciation only on plant and machinery. Which plant and machinery? Any plant and machinery which is new. The condition is new plant and machinery. Are you clear? It should be used for the first time by you. Previously, it was used by somebody else in India, outside India, doesn't matter. It's a second-hand machinery. Second-hand machinery is not eligible for additional depreciation. Additional depreciation is available only when the SSC invest in new plant and machinery. Look at what are the eligible assets. New plant and machinery which is acquired and installed. For claiming additional depreciation, the asset must be installed. Sir, I just bought the asset, sir, 1 lakh. I didn't install it. I can't claim additional depreciation. Sir, I bought the asset. I installed also. Can I claim additional depreciation? Absolutely. How much I can claim? 20% of the actual cost. How much you can claim? 20% of the actual cost. That's a benefit that is given to you. 20% of the actual cost, you can claim it as additional depreciation in addition to normal depreciation. Both put together, reduce it from the block value. Both put together, reduce it from the block value. Suppose if the new machinery I installed on or after 4th October. If the new machinery is installed on or after 4th October, then additional depreciation cannot be claimed at 20. You can only claim at 10. If I purchase before 4th October, you are giving 20% actual cost. Now you are only giving 10% actual cost. No, wait. Another 10% is there, right? Claim it in the next year. No problem. I'll give you benefit in the next year. Another 10%. Technically speaking, whenever you buy new plant and machinery, you are a manufacturer. You are eligible for 20% of the actual cost as additional depreciation. Just that. If you install it before 4th October, entire 20% claim in this year. If you install it on or after 4th October, 10 you claim in this year. Remember, another 10 will be there. You claim in the next year, specifically remembering it. Are you clear? So what are the eligible assets? Every new plant and machinery. What are they? New plant and machinery is eligible, but does not include. What are all not eligible? Second-hand machinery. Whether it's a second-hand machinery, either because somebody used in India previously or somebody used outside India previously, imported machinery, that imported second-hand machinery, nothing but. Yes or no? That is also not eligible. Why? This outside India point is very, very important. You have 35 AD section. Yeah, 35 AD section is there. If you import machinery from outside India, second-hand, it's a second-hand machinery. You import it outside India, and that person has not claimed any depreciation under income tax law on that machine, but he has used it. He claimed it under some other law. He claimed depreciation in that country as per that law, but it's a second-hand machinery. You import it into India. It is treated as a new machine for that section purpose. For that section purpose, it is treated as what? New machine. Whereas for additional depreciation purpose, that's always an old machine. For additional depreciation, second-hand means second-hand. That's it. Imported within India, outside India, doesn't matter. Whereas for 35 AD, new machinery definition includes imported second-hand one as well. But there the concept is not about depreciation and all. That's a condition just for claiming deduction. We'll discuss under 35 AD that logic. Once again I will connect this dot. Clear? Now look at second-hand machinery not eligible. Easy. Machinery installed in office or residential premises. For example, employee staff quarters. Company purchased air conditioners and installed in staff quarters. All staff quarter means nothing but staff house. So house which is given to staff. Some 4 bedrooms are there. All the 4 bedrooms ACs were fitted. Now they are all machineries, but they were used in residential premises. Therefore, they are not eligible for additional depreciation. Or AC installed in office. Office means what? Corporate office is there. Factory, corporate office is there. There, not eligible. Since they are not used in manufacturing process. And office appliances not eligible for additional depreciation. Ships, aircrafts, road transport vehicles, even vehicles not eligible for additional, except those which are used inside the factory. Suppose if the company purchased mini trucks which are only used exclusively inside the factory compound to move goods from one place to another place. Okay, lifters will be there. Okay, so the small vehicles will be there. You can see warehouses, you see lifters will be there where it will be going into the below the entire bunch and then lift it and then keep it like that. So these are also vehicles. They are used only inside the factory. They are eligible for additional depreciation. For example, Amazon is there. They have a warehouse. Amazon warehouse is there. In the warehouse, they bought small robots. Okay, to move small parcels from one place to another place within the warehouse. Entire warehouse is robo operations completely. That robots are eligible for additional depreciation. They're all eligible for what? Additional depreciation. They comes under, in fact, computer. They're eligible for 40% depreciation, and this is also eligible. Additional depreciation. Clear? Next, any mission where 100% deduction or 100% depreciation is allowed. If at all you are getting straight away 100% at a stretch, that particular mission is not eligible for additional depreciation. Are you clear? What is the rate of additional depreciation? 20% of the actual cost for the new plant and machinery acquired and installed during the year. If the assets are put to use for less than 180 days, only 10% is allowed, and the balance 10% is allowed in the next year. Easy. Now look at the concept again, computational format. In our example, you remember all the numbers? 3, 3, 1, 50,000. You remember all the numbers? Okay, now look at how I will calculate additional depreciation. Asset acquired and not installed, how much? 1 lakh. What is additional depreciation? 0. Asset acquired, mission number C, for example. So this actually some, let us assume, asset acquired and installed during the year. How much is that? 3 lakh. Remember, that's a new asset. All are new only. Whatever we purchase is a new only. How much is that? 3 lakh. So what is the additional depreciation? 20% is equal to how much? 60,000. Are you clear? Mission D, again another 3 lakhs is there, which are used for less than 180 into 10%. So how much is that? 30,000. And you know, last year I remember one point. Last year I bought one mission, bought in the last year. That mission cost is 5 lakhs. That time it was used only for less than 180 days. So last year 50,000 only allowed. Another 50,000 rupees benefit is there. I will remember that and then claim it here. In exam they'll give you this in additional information. Generally they'll give you this point in additional. Last year a mission was bought and installed on so and so date. This is the value they'll give you. That's it. You should remember, they have given this for additional depreciation, balance depreciation to be claimed in the current year. So what is the total additional depreciation? 60 plus 30, 90 plus 50, 1 lakh 40. Now immediately you might get a doubt. Here asset acquired but not installed 1, more than 183, less than 183, total 7. Yes or no? Total how much? I think less than 183.5. Sorry. Am I right? Less than 180 days, how much is there? 3.5. You see here? 3.5. Remember that capital expenditure incurred. If it is relating to machinery, that is also eligible for additional depreciation. Because that part of expenditure is new, right? That part of expenditure, some spare part you purchase, that's a new machinery. Spare part comes within the definition of machinery. Yes or no? That's a new mission, for example. That is also eligible for additional. So which means 35,000. Am I right? Hello, everyone agree? 35,000. Then 1 lakh 40. Now here if you see 1, 3, 3.5. Total on what value we claimed additional depreciation? 7.5 lakh. But the value available for depreciation, I think we have done some other question, right? The value available for depreciation, let us assume, is only 6 lakhs. How come? I told you at the beginning itself, no link like this. You can claim additional depreciation if you purchase and install new plant and machinery. When it is sold subsequently, doesn't matter. It doesn't matter. You purchased a new machinery, installed in this year, claim additional depreciation, 20% of actual cost. Use it for less than 180, don't worry. 10 you claim this year, balance 10 you claim that year. Now, the question is, sir, I purchased a new machine. 4th August I installed it. Mission cost is 10 lakh. Mission cost is 10 lakh. Into 20%, 4th August I installed, into 20%. How much is the additional depreciation? 2 lakhs. I want to claim, sir. But guess what? Before 31st March comes itself, the same mission I sold it off. I sold it off. What is the treatment? Tell me first of all. When the asset is bought at 10 lakhs, I will add in the block at 10 lakhs. And subsequently, when the asset is sold, I will reduce as whatever the sale value is, that I will reduce it. And you know how normal depreciation logic works. Coming to additional, same mission I bought and sold in the same year. Am I eligible for additional depreciation? Yes. Because you see, additional depreciation is always acquisition driven. There is no condition attached there. There is no condition. If the same mission is sold within next 2 years, earlier given additional depreciation will be added back. No such. Why? There is a logic behind it. You know, is additional depreciation truly a benefit to the SSE? Is additional depreciation truly a benefit to the SSE? The answer is no, if time value of money is ignored. If time value of money is ignored, there is no benefit because of additional depreciation. Why? For example, I bought a mission for 100. I will claim normal depreciation 15. And I will also claim additional depreciation 20. Now closing value 65. Am I right? This value will be opening value next year. Let us assume next year depreciation is 10, 55. Next year 15. Next year depreciation 9. So 46. Like this. If you total the total depreciation that you claimed over lifetime of the asset, it's 100 only. What is the lifetime of the asset? If lifetime of that particular entire, you spend 100, you are claiming 100 only. Where are you claiming 120? If additional depreciation is not reduced in block, if additional depreciation is not reduced from the block, but separately you are claiming as a deduction, that's a true benefit. Additional depreciation will be reduced from block. Of course, you claim 35 deduction. Under section 32, you claim 35 deduction. But from the block also you are reducing 35. Resultantly, remaining value 65 only you can claim in the balance lifetime. Yes or no? So additional depreciation technically is not a benefit to the SSE. It's just a time value of money. It's just time value of money. If I claim more deduction this year, I will pay lesser tax. That's why you see it's a timing difference. Normal depreciation, additional depreciation, both come under deferred tax accommodation. It's just a timing difference. Yes or no? Did you ignore? Do you ignore? Is additional depreciation comes under permanent adjustment, permanent difference? No, it still comes under timing difference. Just a matter of time. It will be adjusted tomorrow. This year when you purchase the asset, you already spent so much. There is already so much of cash outflow. At least if I give you additional depreciation benefit, your income will reduce, your tax liability will reduce, your cash flow will not affect in this year. For that reason, this benefit is given. Just to ensure manufacturer cash flow not to disrupt. This additional depreciation concept is brought. Are you clear? The same is the case with 35 AD. The same is the case with scientific research. Why in all those cases, capital expenditure 100% flat deduction? There is already a lot of cash outflow. You are already in liquidity crisis. And if I give you at least 100% benefit in the same year, your income at least reduces. For income tax purpose, tax liability will reduce temporarily, but in next year again it will rise. Because next year I will not have depreciation, no. That's it. So it's just a timing difference, temporary difference. It's not a permanent benefit to the SSE. It's a temporary relief to the SSE for cash flow. Clear all of you? So that's additional depreciation concept. Until now, clear or not? So if I purchase the asset and sell the asset in the same year, still you are eligible for additional depreciation. Sir, I purchased it this year. I didn't install it. 25, 26 I purchased. I didn't install. Next year, 26, 27 year, I didn't install. That next year I installed. Which date? Before 4th October? Fine. You remember original cost 3 years back when you bought? Calculate additional depreciation, still claim it. So additional depreciation, the only condition is installation. You acquired it, installed which year, check it out. That's it, claim in that year. Whether that asset is there physically that year or not doesn't matter. Are you clear? Because additional depreciation benefit is given the moment you buy the asset. Whereas normal depreciation, you remember, sir, I asset acquired this year, but I didn't install. In this year, for normal depreciation allocation, you may not get depreciation this year. Next year, still I didn't install, sir. Still, it's forming part of opening WDV. Because of the defect in the mechanism, you are claiming depreciation which is normal even on the machine which is not installed. Whereas additional depreciation, it is nowhere linked with the table. It is nowhere linked with the depreciation splitting, all that. Directly you purchased, installed, actual cost multiplied by percentage. So that value is irrelevant, all that. Hello, everyone. Confident or not? Additional depreciation concept, confident or not? So point number 1, additional depreciation is available only for manufacturers and power sector. That too power sector only when they're following block of asset approach. 2, additional depreciation is only in respect of new plant and machinery installed in factory. Indirectly, second-hand machinery not eligible. Installed in office and residential premises not eligible. Vehicles, ships, all that which are used outside the factory not eligible. Yes or no? Fourth one, 100%. Any machinery on which 100% benefit already available. Then there is no point of computing additional depreciation. Are you clear? Now, how much additional depreciation? 20% of the actual cost. Yes or no? If the asset is installed before 4th October, 20% of the actual cost you can claim in this year. If the asset is installed on or after 4th October, 10% only you can claim. Now, one last point I'll tell you. One last point. Okay, 5 more minutes. Is that okay? 5 minutes. Okay, no problem. Next class, if at all any of you there for the next session, I'll tell him to wait for 5 minutes. No problem. 10 minutes I'll give compensation. Okay. Yeah. Next one. Look at. Suppose opening WDV. Let us assume it is 10 lakh. Plus additions this year is 0. Additions this year is 0. Minus deletion this year is also 0. So WDV of the block is 10. Minus normal depreciation for the current year is, let us assume 4, because it's a 40% block. Let us assume it's a 40% block, 4. And guess what? Last year 10% additional depreciation claimed. And last year the 10% was approximately 10 lakh. The 10% only 10 lakh. Another 10% is there, which is also equal to 10 lakh. I want to claim 10 lakh now here. I want to claim 10 lakh additional depreciation now. I want to reduce it from the block now. I cannot reduce more than what is there in the block. I cannot reduce more than what is there in the block. How much I can reduce here? Only 10. 4. Last year additional depreciation left how much ma? 6. Hello. What is left? 6. Sorry. 10 is left, but I can claim only 6 because in the block after from 10 minus 4, if I remove it, only 6 is there in the block. So I can claim, I can reduce. There's a difference between I can claim, I can reduce. Please remember. I can reduce depreciation still how much from the block? Only 6. So I will make the block value 0. But guess what? How much reduction in this year I will get under section 32? How much deduction I will get under section 32? Normal depreciation of current year 4 lakh plus additional depreciation of 10 lakh. 10 lakh. Total 14 lakh you will get deduction. Remember 32 is a deduction section. Deduction for depreciation. Whereas how much you will reduce in the block? Since block value is not sufficient because of brought forward or current year additional depreciation, whatever reason, okay, total depreciation is exceeding the WDV value, then the depreciation total amount for block purpose I will restrict to WDV value, make the block value 0. Why? Block cannot be negative. However, depreciation claiming point of view, I'm not worried about block value. For claiming depreciation, I'm worried about what is actual depreciation. Hello. This is one more. This is extreme rare, they can ask. This is extreme rare. So the point is, how much depreciation you are claiming under section 32 can be different from the amount that you are reducing in the block. The lesson is, how much amount you are reducing in the block towards depreciation. That amount can be lower than the amount of depreciation that you are claiming as reduction under section 32, because this format is 43 subsection 6 format. Depreciation deduction you are getting under section 32. As per 32, normal depreciation, I followed format, I computed. Additional depreciation as per 32, I computed. Total 14 lakhs. Section 32 satisfied. Now, as per 43, okay, block computation. Block value 10 lakh. Okay, block value 10 lakh. Normal depreciation 4 lakh. Additional depreciation which I brought forward, yes, on which I did not claim, is 10 lakh is there. But in the block, I am not having 10 lakh value left. If I reduce 10, what will happen? Block will become negative, which is not permitted as per 43. Therefore, I will bring the block value to 0. Which means from the block, how much towards additional depreciation I reduced? Only 6 lakh. That doesn't mean I can only claim 6 lakh. I can claim 10 lakh as per section 32. But I will reduce in the block only 6 as per section 43, and both are correct. Do you understand? Hello? Everyone, this problem is there in CMA final study material. Okay? This problem is there in CMA final study material. Even in CA final also, CA inter also, we have a similar problem in past exams. Okay? So, claiming depreciation is different. Reducing from the block is different. So, actual depreciation that you are claiming as deduction under 32 can be higher than whatever depreciation amount totally that you are reducing in the block. The difference is only because of additional depreciation. This difference is only because of what? Additional depreciation. Sometimes what will happen is this year opening value 10 lakh. You know, assets purchased 100 lakhs. Okay, assets purchased for 100 lakhs. So gross block value 110. Now part of a block is sold for 100. Part of a block I sold for 100. Remember, this entire asset is new plant and machinery. Okay, now what is the W value? 10 minus normal depreciation. What is normal depreciation? Since only 10 is there, WD value, so I will allocate to less than 180 days. Let us assume this 100 lakhs purchased is more than 180. More than 180. Let us assume it is more than 180. So value available for depreciation is how much? 10. So first I will allocate to assets acquired but not used. That value is not there for us. Then assets acquired and used for less than 180 days, 0. Balancing figure is 10. On this 10, let us assume depreciation rate is 40%. So what is the depreciation? 4 lakh. So normal depreciation 4 lakh minus additional depreciation. Remember this entire 100 lakh worth of machinery was installed in factory. Yes or no? Part of a block is sold because we have a higher value. Part of a block is sold by us because of old machinery got appreciated. Because of appreciation, we receive some good amount. Okay, yes or no? Fine. So, additional depreciation, 100 lakhs is new machinery, 20% is the additional depreciation rate, 20 lakh. Sir, if I have to reduce 20 lakh here, I don't have 20 lakh, only 6 is left. So I will reduce here and make the block value 0, but still I can claim additional depreciation how much? 20 lakh, because section 32 permits me to claim 20 lakh because I installed new plant and machinery. That's it. I complied with 32. Where did I non-complied? Did I violate anywhere by doing this? Sir, section 32 additional depreciation I want to claim 20, sir. Normal 4, sir. Total 24 lakh I want to claim 32 section deduction, sir. Can I claim or not? Point number 1, 4 lakh. Do you agree for the 4 lakh logically? There you not have any doubt. Point number 2, additional depreciation 20 I want to claim, sir. I will prove that I have not violated the section. I will prove it. What I will prove it? Did I purchase? Yes. Did I install? Yes. How much is the rate? 20%. What is the amount? 20%. That's it. 24 lakh you claim. Are you clear? But block value is not sufficient. That is not relevant in 32. Yeah? That is relevant in 43. Bring the block value to 0. That's okay. Able to understand. This is the only place where because of additional depreciation some benefit is there. Because of additional depreciation some benefit is there. True benefit is there. Irrespective of time value of money. True benefit is there for the SSC, which is a very, very rare scenario. Clear all of you? MCQs relevant. If at all they ask a depreciation very tough question, you can do it. That's it. Normal depreciation you understood. Additional depreciation you understood. I hope you understood installed or not installed. That don't mug up. Everything very logically I told. Yes or no? That's it. Done. With this depreciation topic 90% over. Still we have left with some more concepts which will take 1 hour discussion at least. Okay. But they're very easy. They are not at all difficult. Okay. So we'll continue in the next session. Until now confident everyone. That's it.